pain trade puts the squeeze on stock and bond investors alike. Live from Studio 2 at a rain-drenched Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking you off to the closing bell here in the U.S. About 2 hours ago, you take a look at stocks right now. They're actually higher on both the S&P 500 and the NASDAQ 100. The S&P 500, of course, off its worst week since March last week, rebounding a little bit today, up about 0.3% or so of a percent. Big tech up about 0.2 as well. That's even as that bond sell-off continues, which we're going to get into in a big way. You look at the 10-year Treasury yield, currently up almost 10 basis points. The levels that we're talking about, pretty amazing, well above 4.5% at the highest yield level going back to 2007. Just some really amazing moves that we're seeing, particularly at the long end of the curve. And Romaine, I did just want to end on oil here. Of course, we've been watching this months-long sell-off in the energy market. Crude oil right now, though, dropping a little bit below $90 a barrel.
All right, a couple of key developments coming out of the weekend, Katie Greifeld, affecting markets here in the U.S. here. We start with, of course, the big drop in Asian equities. That was led by a slump in Chinese equities, led by a plunge in property developers. This after Evergrande's onshore unit says it actually missed principal and interest payments on a key bond just issued a few years ago. That stock slipping 22% in Chinese trading. A few other stocks, including Sino Ocean, down 12%, Country Garden down about 8%. Overall, you got a Bloomberg intelligence gauge out there of developer shares giving back 7% on this Monday. That's the worst one-day decline, believe it or not, of the year, and it adds to what is now a 34%, $56 billion loss in valuations just in the past 9 months alone. It's a pretty dour setup when you consider the drop in volume heading into what is going to be a multi-day market holiday for Golden Week over there in Asia, which kicks off on Friday. So that could have an outsized effect on some of the price action that we're seeing over there. Meanwhile, back here in the U.S., we did get some interesting price moves for the Hollywood studios. Reports that labor contract talks with the Writers Guild may have finally found enough common ground to get folks back to work. Netflix, which is among the big studios, is largely seen as being the biggest beneficiary from the proposed new agreement. That's moving higher on the day, but the rest of the stocks, kind of a mixed bag here. Paramount, Disney, and Warner Brothers oscillating between gains and losses on the day. Remember, the actors' strike that started in July still appears to show no meaningful signs of compromise just yet. But, of course, we saved one of the biggest stories for last here, and that is what we're seeing in the Treasury market. That's where most of the activity is, a continuation of the sell-off in the long end of the curve that's been unfolding for about 4 weeks now, Katie. But some strategists out there, they actually see a potential opportunity to buy here, particularly in that so-called belly of the curve.
It's my favorite thing to talk about, the belly of the Treasury curve. Let's talk about it a little bit right now. You're looking at all sectors of the curve right now, and as you can see, it's been pretty much a straight march higher for all of those maturities. But if you focus on the belly, that is that yellow line there, about that 5-year tenor. So you are starting to see some appetite there, if you will, of course, when people say maybe we don't see rate cuts next year or maybe at the end of next year. But if you think there's going to be rate cuts in the next 5 to 7 years or so, that should benefit the belly. And of course, picking your spots on the curve right now is very important when you think about what a battering the bond market has taken. And if you take a look year to date, we're heading for the 3rd straight year of losses when you look at the ag. And as you can see, that is very rare when you go off looking back through history. The average return somewhere closer to 6-7%. So to see a 3rd straight year of losses really speaks to this amazing re-rating that we've seen in the Treasury space so far this year, Romaine.
Of course, everyone that is out there still looking for opportunities, Katie. Let's get some insights out of our first guest here to kick you off to the close. Gargi Chowdhury, head of iShares investment strategy for the Americas over at BlackRock, releasing their fall investment outlook. And Gargi, great to have you here today. Let's get right to that outlook here, because there has been a lot of discussion about whether now is the time to maybe embrace certain parts of U.S. Treasuries here. You and your team seem to think that there is opportunity in the belly of the curve.
Sure, Romaine, it's great to be here. Thank you for having me. And absolutely, one of the things that we talk about in our fall investment directions that actually came out this morning is the attractiveness or the relative attractiveness of the 5-year point of the curve, the belly that Katie was talking about earlier. And the reason is a fewfold. Number one, of course, is the income that you're generating, much above that 4.5% level, sitting in the 5-year part of the curve. But secondly, it is the asymmetry that you have right now in the 5-year point, where if you believe that rates can still perhaps move up 100 basis points, owning that 5-year for the next year. So if you hold on to it for the next year, you are still going to be flat on a total all-in return perspective.
Okay.
However, if yields actually move lower by 100 basis points, you're going to have close to double-digit returns. And that asymmetry is the best on the 5-year part of the curve, which is why we prefer that more than any other area of the curve.
I'm going to ask you a question then that you probably won't be able to answer, or maybe you will be. And that is, I guess, when do we start to see that drop in rates? Because a lot of people had called for that quite some time ago. And of course, as you've noticed, over the last 3-4 weeks, we've seen a meaningful uptick in those rates.
Yeah, it's a great point. And I think where you're talking about is also important, right? So which part of the curve are we talking about when we talk about the fall in rates? I think the long end, so anything that's 10 years and higher, can actually remain sticky at current levels for some time. There's a lot of supply coming into the markets. Term premium, so what you expect to get paid to own further duration, is still fairly low. It's still negative. So that still needs to normalize. But if you look at the 3 to perhaps the 5 or even the 7-year part of the curve, that I think is getting to levels, and we think certainly for the 5-year, it's already at levels where even if rates don't move significantly lower, where if it just hovers around the levels they are at, or even moves higher to 100 basis points, you still have cushion. So you can still earn positive return while rates move higher. What can drive them lower? The things that we are looking for, and we've been talking to clients across the country, and they're asking us the same question: when can we expect to see rates go lower? And I think it's really around a few things. Number one, the labor market has to show some signs of slowing down. So the inflation has already moderated, but I think the labor market is the next shoe to drop. And if we see some moderation on the labor market, I think the 10-year or even the 5-year can stabilize. The second is really from the Fed. This latest steepening move is certainly based on the Fed's sort of, their forecasts. And I think they need to pull back on their hawkish narrative just a little bit.
Let's talk about cash, though, because I look at some of the iShares products. SGov in particular has been on fire, as has anything that's tracking anything with basically a 6-month duration or less. I see what you're saying about the belly, but if I'm worried about reinvestment risk, I heard from Jerome Powell last week saying that rates are going to stay high for quite a long time. Does that become more of a moot point?
I think it depends on the type of investor you are. So right now, if you're really nervous about the markets, if you think that we can see further deceleration in the stock market here, holding cash at 5.25 makes a lot of sense. So SGov or SHY, something that gives you that very front end, and we've seen tremendous amount of inflows into that, and specific I bond maturities. So sort of instruments that act like cash and mature like bonds in the very front end of the curve. But I do think, especially given our view, and we talk about this in our investment directions, that we think that the consumer can soften, consumer growth can soften a little bit from here in the fourth quarter. If you were in the same camp as us, where you think, again, not calling for a recession, but just a slowdown in Q4 from Q3's run rates, I think that's where owning a little bit of duration, again, around the 4 or 5 year point, with something like an IEI or something like even with something like the ag or mortgages, we think make a lot of sense here.
And Gargi, just quickly, talk to us a little bit about some of the unknowns out there, some of the wild cards, if you will, because just in the past hour, we actually heard from Moody's saying that a U.S. shutdown would be negative for the U.S. credit rating. How are you thinking about that?
Yeah, so with the government shutdown in particular, of course, that's an unknown, but depending on how long that lasts, can actually be a blip, right? So we'll obviously have a drop in growth every week that the government is shut down. But once we reopen, that does come back to growth. We've seen that in the last sort of 40 years. We've had about 20 shutdowns, and every single time we've had that growth come back. I think the unknowns here, the one that I'm thinking about quite a bit, is really around the big one is around oil prices. I think to what extent can oil prices continue to move rapidly higher as they have over this past quarter, and what does that mean for the consumer? How much does the consumer slow down as a result of higher prices, and what does the Fed have to do if headline inflation, instead of turning lower turns higher, and this time they can't get to call it transitory. And that's actually one of the reasons that we're telling investors to stay invested in the markets, but particularly pay attention to the energy sector of the broader markets.
Katie, I'm a little surprised you asked her that question.
Why is that?
You're being hard here.
You know, I just got it. We've got some breaking news. We've got an expert.
Okay.
I want to hear your thoughts.
Okay, all right. Well, always great as long. You're such a Taurus, you know that?
Yeah.
All right, Gargi, great to see you. Great to catch up with you. Gargi Chaudhary there, head of iShares investment strategy for the Americas over at BlackRock, helping us kick off to the close here on this Monday afternoon with a look at the writers reaching a tentative deal with Hollywood studios. Actors, though, still walking those picket lines. We're going to talk about what it means for the industry and what could happen next.
Plus, Congress faces a deadline of midnight Saturday to pass a federal spending measure or face a potential government shutdown. We'll have the latest on the negotiations and, of course, what it means for the markets.
And Gargi was just talking about energy prices. We're going to go back to the Ham Institute American Energy Security Summit in Oklahoma City, where top executives are talking about the potential for $100 a barrel on WTI. That conversation and so much more coming up in a bit. This is Bloomberg.
After 5 long months, Hollywood writers and the studios reached a tentative deal over the weekend to end those strikes. Now, the agreement settles one of the 2 walkouts that have shut down film and TV production. For more on this deal, let's bring in Chris Palmieri out of LA, who, of course, has been covering this story closely for Bloomberg. Chris, tell us a little bit about this tentative deal. What did we wait 5 months to see?
Well, you know, this was billed by the writers as really sort of a transformative deal. It's the first one they've really hammered out in the streaming TV era. They wanted a lot of guarantees about these new technologies, artificial intelligence. They want to make sure they're not replaced by robots. They wanted a greater share of royalties and transparency in terms of the data that comes out for shows on streaming. So those were 2 of the biggest issues, and there was some movement on those 2 factors.
So it looks like they did win some concessions here. What do we know about the state of that agreement, the state of the negotiations, the idea that this is tentative? How much confidence do we have that this is going to be a done deal?
Well, we know that they got salary increases. We knew they've got some guarantees in terms of a minimum number of writers per show, which was another a big sticking point. We'll know all of the details possibly tomorrow. Where it's going from here is the boards of the Writers Guilds East and West will meet and sort of approve the agreement. Then it goes to their members, which are some 11,000 of them, to vote. That could take a few days, but the boards can say that the members can go back to work as early as tomorrow in an interim basis.
So they could go back to work, but of course any actual filming will require an agreement with the actors. Where do those negotiations stand?
Haven't restarted yet, but we expect them to do so very shortly. The Actors Guild put out a statement last night, congratulating the writers, and so it certainly seems a lot of the same issues were covered. Streaming residuals, artificial intelligence, and that. But we'll see some shows go back, that weren't as dependent on writers, talk shows, daytime and night. Not as dependent on actors. So we're likely to see some news later this week about what returns.
All right, Chris Palmieri out in Los Angeles to look at the Hollywood writer's strike, which at least for right now appears to potentially be at an end after 5 long months. Meanwhile, the UAW strike entering week 2. We did hear from President Shawn Fain of the United Auto Workers calling for an expansion of that strike, with GM and Stellantis facing walkouts at 38 more facilities after talks last week failed. The president, Joe Biden, heading to Michigan on Tuesday. Former President Donald Trump scheduled to be there on Wednesday. Our Detroit bureau chief, David Welch, joining us today on this Monday. And let's start off here with some commentary that we heard over the weekend, David, out of the Transportation Secretary, Pete Buttigieg, who seemed to be relatively optimistic that not only could a deal get done, but in his words, it would be a win-win for all. I think we're having some issues with David Welch's audio out there in Detroit. David?
Yeah, I'm here.
Go ahead.
Yes, look, what Pete was saying is, in addition to calling for a win-win, he was kind of using the UAW's own words. He was saying that there should be record compensation and record benefits. And that's exactly what Sean Fain's been saying all along, is that record profits equals record contracts. So you see the administration's language clearly pivoting toward the union, that they're going to be, they're on their side. And Biden needs that, because you have Trump in Michigan campaigning for union votes. And a lot of union members do actually vote Trump. And the Democrats are going to try to steal them back. Workers have traditionally voted for Democratic candidates. You could really look at this week as being a precursor to the 2024 election, assuming Trump gets the nomination, and most think he will. So you've got the two likely candidates here fighting for union votes on picket lines or during a strike right here in town.
Well, David, that's what I want to talk about. Clearly, you've seen the Biden administration, some of these Democratic politicians lining up behind the unions. What have we seen from the Republican side?
Look, some of the other Republican candidates have not been so friendly to the union. You've had them saying things like, they should be replaced if they're on strike. Others have sort of said, they feel sympathetic with the workers, but they've only used that to say that Biden's electric vehicle agenda is costing them jobs. So it's, the Republicans, including Trump himself, are pivoting this toward, hey, the union is really striking here because they're worried about losing jobs, and they're worried about losing jobs because of electric vehicles that Joe Biden is ushering in with billions of dollars. It hasn't really been, hey, we're sympathetic toward the worker, which is the message the Democrats are trying to win votes with, and that's what Biden will likely be saying once he's here.
All right, David, really appreciate your time and your reporting. Our thanks to Bloomberg Detroit Bureau Chief David Welch. And Romaine, it's really interesting to see this become a political issue and see how the different sides are trying to handle this.
Yeah, we kind of knew it would at some point here. And of course, it really dovetails considering sort of what drove the last couple of elections. We know that Michigan has been a swing state. Obviously, some of these other manufacturing states like Ohio have been critical, and Pennsylvania have been critical to the election of who becomes president. So it makes sense that the two leading candidates would want to sort of court those voters. And I think we talked about this last week. At least if you believe some of the polling, seems like the rank and file is maybe a little bit more amenable to some of the language coming out of Trump, while the leadership seems to be more amenable to what they're hearing out of Biden.
Yeah, an interesting split there. And just when we think about the position that the Democrats are in right now, you remember when we had the rail unions and a potential strike there. It was pretty awkward for the Democrats trying to maybe enforce that.
Exactly. For a president who basically says he's the most pro-union president in the history of the United States of America. And there were a lot of folks that were part of that union who basically felt that, well, he didn't really stand up for them, at least not to the extent that they wanted him to. So it's a tough situation. It'll be interesting to see whether, if this does drag out, does it force his hand to intervene and then once again maybe have to upset some of the potential voter base that he needs?
Yeah, it's going to be a fascinating couple of weeks. And sticking with the government, stay with us, because coming up, we're going to have the latest on the potential for a U.S. government shutdown at midnight on Saturday. That conversation coming up next. This is Bloomberg.
All right, let's turn now to U.S. politics. The Speaker of the House, Kevin McCarthy, and his allies spending the weekend working on a short-term government funding measure with just 5 days to go until a potential shutdown of the federal government. Party infighting, though, between McCarthy's party, the Republicans, and the conservative hardliners there, seeming to put a little bit of a roadblock here into getting a deal done. Laura Davison joining us right now from our Washington, D.C. bureau, and everyone sees the calendar there. We've been in the past at this level of brinksmanship before, Laura, but there's some concerns that this time is different, and I am curious as to, has anyone really sat down to assess the potential economic impact should we actually get to that September 30th date?
Yeah, the tenor is different. Congress comes up on these deadlines all the time, and generally the mood is that, no, we don't want to shut the government down. We want to come up with some deal, and if we can't come up with the deal before that deadline, we'll pass some sort of short-term stopgap measure to give Congress more time to negotiate. That is really not the mood, particularly in the House right now, where there's a small group of hardline Republicans, and remember, the Republicans just have a narrow majority, just 4 or 5 seats, so a very small number of people can say, no, we're not going to pass anything, and effectively shut the government down. shutdown. What has a lot of both moderate Republicans as well as Democrats frustrated is there are a lot of knock-on effects. A couple-day shutdown doesn't really affect things, but if we see something like we saw back in 2018, 2019, when the federal government was shut down for more than a month, we're looking at things like economic indicator reports that are delayed sometimes by months. You look at, hits to GDP. Last time it was $11 billion, $3 billion of which was never recovered. Other things like government services, you're going to see national parks shut down. Some essential services like mail delivery will stay, but there's a lot of gray area on, what happens to some things like tax payments as well as student loan repayments that are set to start at the beginning of October. If the Department of Education is shut down, how does this process work? It probably makes for a very messy restart to all of that.
Well, Laura, what are you hearing from your sources about current thinking about how long this shutdown could last if indeed we don't get a deal?
Yeah, sources really are saying that this is going to be, that Republicans are very much dug in on this. So we're looking at weeks, potentially more. The whole idea of going into a shutdown, that what hardliners will tell you, they want to extract some sort of concessions from Democrats. They want to hold out as long and try to win things over. History tells us that generally the side that causes a shutdown rarely gets anything in return, but that pressure starts to mount and they dig their heels in longer and longer, ultimately resulting in a lot of knock-on effects without actually achieving the political goal that was at the center of the whole shutdown.
And just real quickly here, Laura, when we talk about the idea of a deal potentially getting done, what's being negotiated right now? Is it largely just Kevin McCarthy negotiating within his own party, or are the Democrats involved at all?
There's a couple different factions. So it's mostly McCarthy working with his party, but there's this group called the Problem Solvers Caucus. This is a group of Democrats and Republicans in the House. They've put up some of their own ideas as well. But remember, it's McCarthy here that, one, has the ability to control the House floor, as well as his job is at stake. If he does something that these hardliners don't like, he could get ousted. So he's very cautious, and that's really the person at the center that will be making all the decisions going forward.
All right, the countdown begins. Laura Davison down in our Washington, D.C. bureau. I have a feeling Katie Greifeld, we're going to be checking in with her multiple times this week here, as everyone, I think, is now starting to bite their nails. This could have an impact. We talk about a recovery in that lost revenue, but we forget there's a big chunk of that lost revenue that never comes back.
And you also think about more immediately what it means for the Fed. For example, we wouldn't get a CPI report on time, theoretically, depending on the length of this.
Then what are we going to obsess over?
I don't know. That's the thing. We should ask the Problem Solvers Caucus.
The Problem Solvers Caucus.
I'd like to know.
Yeah, I'd like to see who the members of this Problem Solvers Caucus are. Romaine Bostick and Katie Greifeld here trying to solve problems with regards to the market today. A mixed day on this Monday, coming off what was one of the worst weeks that we've seen all year for U.S. equities. Stick with us. This is Bloomberg. This is the countdown to the close. Almost 2:30 here in New York. A mixed day for the broader markets and a mixed day for commodities as well. Abigail Doolittle is standing by right now with our commodities close. Abigail.
It is a mixed day indeed for commodities. Overall, though, Romaine, we do have some decline. So here are some of the big weights, drags on the Bloomberg Commodity Index. New York crude oil down about 0.4%, slipping back below $90 per barrel. From a chart technical standpoint, it appears as though oil may drop back down closer to 80 before potentially rising above 100. And of course, we can bring China and some of those property woes happening over there into the picture as the world's largest user of natural resources. That's probably weighing from a fundamental standpoint, and the idea that maybe some demand will come off the market. Copper down 0.7%, silver down 2%, and platinum down 1.8%. The metals getting hit the hardest, and this, of course, has everything to do with the dollar rising. If we take a look at the Bloomberg Dollar Index versus a Bloomberg Precious Metal Index over the last 2 months, since really the July Fed meeting, when the Fed indicated that they are still around, higher for longer as a possibility, you can see precious metals down, the dollar higher, up about 4%. Of course, metals denominated in dollars, super sensitive to dollar strength, and we see it right there, especially since there's no real use for precious metals, Romaine. We can see that weakness clearly.
Abigail Doolittle there with a closer look at what's going on in the commodity space. Let's stay in that space right now. The American Energy Security Summit taking place in Oklahoma City. Our very own Alex Steele is down there right now asking some of the industry's top executives about the prospects for oil prices.
The reason Prince Abdulaziz has been doing what he's been doing recently is to balance the markets, because there was a time of overspend followed by a long period now of underspend in the industry and then the pandemic. So now to balance the markets is best for all of us, because if prices, if he wasn't doing that, then prices could potentially go way up to over $100. But in balancing the market, you protect the downside so that you have a healthy oil and gas industry.
The higher price is a reality that we're going to have to deal with as we think about our investments and we think about the energy needs of the globe. And the fact that we know today that it's being more broadly recognized that oil and gas is going to play a key role in our sources of energy in that energy stack over time.
All right, the heads of Continental, Occidental, and a few other folks that Alex Steele has had a chance to sit down with while she's down there in Oklahoma City for that summit. And give us a sense here, Alex, about the discussion about oil prices, which, as I'm sure you know, have gone up pretty significantly just over the past couple of months. Are the people you're speaking to, do they think that that increase that we recently saw is going to continue?
I mean, yeah, kind of. The most significant part of it, actually, was that we used to be in a range like 60 to 80, right? Where 60 was kind of the floor. That's where you want to make investment decisions. But it feels like the conversation is shifting now to 80 to 100. And now 80 is that floor where you make investment decisions. That's a very different profile than we were just at about 6 months ago. And they all really see the volatility. And volatility can be really tough if you're trying to make investment decisions. And that's a huge, huge shift change for some of these CEOs.
Well, let's think big here. Let's talk about the upper end of that range, $100 a barrel. What does decision-making look like at $100 a barrel? What do the politics look like?
Yeah, well, then you get to 100, and then you start talking about 150. I think it was Doug Lawler of Continental that says that eventually you could see 150 because of the kind of underinvestment that we've seen. And what they mean by underinvestment is that you pump money into the existing oil system, but that's just to keep oil at a consistent pace. That's not to grow production. Then to grow production, you need a higher price, and then to do exploration, you need even a bigger price and clearer policy. So then we're in a whole different ballgame. Then we're definitely talking recessionary fears. Then we're definitely talking demand destruction. The tension, though, Katie, to your point, which is so interesting, is what do you do with policy in Washington, right? A lot of these oil companies like the IRA because they get subsidies for their carbon capture unit, for hydrogen, for stuff that they're actually investing in. Yet they want a government that is more friendly to oil, which just means more clarity so they can actually explore and not just produce more, but maybe explore more.
Well, square that circle for me, Alex, because whenever I hear this idea that they want a government that's going to allow them to sort of explore, allow them to drill more, I feel like that always runs up against this idea of where? Like, where are the reserves that we don't know about yet that are going to be profitable enough for these companies to go there? It's easy to say this, but is there something there in the ground that we're missing?
I mean, maybe federal land. They're all going to talk about the moratorium on federal permitting. Maybe we're talking about Alaska. But the irony is, Romaine, to your point, is that if you talk to any of these oil CEOs, you're like, all right, you're unleashed. Go for it. Drill more. Are you doing it? They're like, no.
Yeah.
They're like, we like capital discipline. We're not going to do it. So that's very confusing to me.
Yeah, well, to me as well, Alex. You know a lot more about this than us. Alex Steele out at the American Energy Security Forum in Oklahoma City. We'll check in again with her soon. Again, I am sure. Katie Greifeld. And the interesting thing, you know, we didn't get a chance to ask her, but she had a chance to interview Nikki Haley, one of the Republican candidates for the nomination for president. And Nikki Haley talked about this idea of trying to get gas down to around $2 a barrel. And I think Alex pointed out that that would kind of translate into like oil around 45 bucks a barrel, which I'm like, really square that circle, because I'm sure most of the people in that room don't want to see 45 bucks a barrel.
Yeah, that's the thing. It's a very delicate dance to do when you're thinking about how consumers feel higher energy prices and everyone else in that room who would maybe like to stay at these prices and explore even more. I don't envy the politicians trying to walk that line right now, but still ahead on the close.
Maybe the Problem Solvers Caucus.
Maybe we should get them in here. I don't know. I want to talk to these problem solvers. Maybe they can talk about the hype around one of the hottest IPOs this year. Has it already cooled? We're going to talk about Instacart in our top calls coming up next. This is Bloomberg.
All right, time now for our top calls, the big movers on the back of analyst recommendations. And we start off with CarMax. The Queen telling me that Wedbush putting the pedal to the metal with an upgrade to outperform. better mix of older and more affordable used car inventory relative to its peers provides an opportunity to increase market share. The analyst also saying a prolonged strike by the United Auto Workers could give used car dealers like CarMax more pricing power. Those shares up 2% on the day. Next up, Nike. Jefferies downgrading the sneaker giant to a hold ahead of an earnings report this week. The analyst girding for a sales slowdown, citing a consumer survey where 87% of respondents with student debt said they will reduce their overall spending, with apparel and footwear the first thing on the chopping block. Shares down fractionally on the day. And finally, Microsoft. 59 analysts covering this company, and up until today, only one of them had a sell rating. Guggenheim, which downgraded the stock to sell back in January because of the risk posed by what most people thought was going to be an economic slowdown, upgrading back to neutral today on tailwinds from artificial intelligence. Nevertheless, Microsoft shares fractionally lower on the day. And those are some of our top calls. We do want to stay in the tech space and in the sell side space and talk about, well, the newly public Instacart. Our next guest was the first analyst tracked by FactSet to set a rating on the shares, giving it a hold. He says, well, they were in the right place at the right time during the pandemic, but he sees a tough road ahead. Let's bring in Bernie McTernan over at Needham to talk a little bit more about this call. And Bernie, let's just start off with the elephant in the room. I think everybody at some point or another either used Instacart or maybe tried to use it during the pandemic. My question is that type of interest that we saw in 2020 and in 2021, is that still there here in 2023, heading into 2024?
Yeah, no, and thanks again for having me on to start. And that's the reason why we have a hold rating on the stock. If you look at just from a top-down perspective for the industry, only 12% of grocery sales are done online right now. So again, you had this huge catalyst of the pandemic with getting people to try these services for the first time. And now we just think, what's the catalyst really to potentially even double penetration from here? We think it's going to be a longer road ahead. And then you throw on competition on top of that. 80% of Instacart's GTV, that's coming from their marketplace. And we think competitors like DoorDash and Uber are going to become increasingly competitive in the grocery space over time.
We'll talk a little bit more about the competition, because this seemed to be absent from the discussion when it came public. The idea that Instacart has something relatively unique, but there's got to be that question as to whether some of the other grocery or delivery companies, if you will, can sort of move into this space. You also, of course, have the elephant in the room with an Amazon or one of these other big players that I feel like could just flip a switch if they ever decided to get their act together and do the same thing.
Yeah, no, it's a great question. And so I think it's important to give the timeline here for how Uber and DoorDash, or when they really announced grocery. And it was in the summer of 2020. They actually didn't even have an announcement with their first major grocery chain until in 2021. And really, so they were late to the game with grocery. They were, trying to really get the product right. I still think they're in that mode. I do think grocery from a product technology standpoint is more difficult than restaurant, but I think over time they should be able to figure it out. And Dara, Uber CEO, was at a competitors conference a couple of weeks ago talking about how later this year, that's when they're really going to be integrating Corner Shop with Uber Eats. That's going to add a lot more product functionality. So again, I think that Instacart had a decade-long head start, and that gap is going to be able to close over time. And it was funny, when we went through the report, we were really focused on Uber and DoorDash. And usually when you're talking about competition, there's a spot where Amazon is touching. It doesn't take that long to get to them. With Amazon, we can put them in the same camp as Walmart, where it's these one-piece solutions. And I think that's why if you look at the whole grocery delivery market, we think Instacart actually lost share, even if it was stable with those third-party delivery companies like an Uber or DoorDash over the past year, because Amazon and Walmart have been growing the market. And we think that that's the risk, that those chains continue to take share in the overall category.
Well, Bernie, if you take a look at the filings prior to the IPO, it was interesting that you saw that orders on the platform were pretty much flat in the first half of 2023. But then you take a look at advertising revenue. It actually accounts for nearly a third of Instacart's total revenue. And couching that in the competitive landscape, is that silver lining from advertising enough to cushion the blow of Instacart losing market share here?
Yeah, and so advertising is how we have mid-single-digit growth for GTV, but high single-digit growth for the whole company. And they're operating as a retail media network. This is a really highly effective form of advertising where it's in a closed-loop environment, meaning the transaction is happening the same place that the advertising is happening. So, you can really have, 100% attribution. It's powerful for CPG advertisers. The only thing is that advertising, was doubling as they're approaching $1 billion in terms of advertising revenue. It is slowing down. And actually this is one area of pushback that I wasn't expecting from investors, but really focused on Instacart actually competing with grocers for those same CPG dollars. So as consumer spending shifts more online, those advertising dollars are following. And so they're competing with that same, competing with their partners for the same dollars.
And Bernie, you're one of 3 analysts that's initiated coverage of Instacart. All 3 of those analysts, including yourself, have a hold on Instacart. What would you need to see that would bump you up to a buy?
Yeah, so we did a scenario analysis in our note where we said, what's the bull case and what's the bear case? And in the bull case, that's when growth can really look like an Uber or a DoorDash. And I think that's why, that's how you get to a high teens, multiple $55 bull case we have on the stock. And so that would be these grocery gains that we saw during the pandemic, actually having this network effect where you're looking at 200 basis points of annual share gains for grocery adoption. And that can really drive GTV a lot faster. Advertising is based on a percentage of GTV. So you could, get a lot faster revenue growth. And then this is a company that's showing a lot of operating leverage. So if you look from 2019 to 2023, we think that there's going to be a $1.1 billion swing in EBITDA. A lot of that is, really leveraging off fixed costs, but you need to have that revenue growth to have that operating leverage. So in our bull case, we would have greater operating leverage. In our bear case, it's that grocery, online grocery gains really go back to pre-pandemic levels, talking less than 100 basis points per year. So then you're looking at mid-single-digit revenue growth, high single-digit EBITDA growth. If you look at a comp set of other tech companies with high margins and low growth, that's how you get a high single-digit multiple, and that's where our $7 bear case comes from.
All right, Bernie, we're definitely going to have to catch up again over the next month or two, particularly ahead of the earnings that we're looking at coming in November. Bernie McTernan there over at Needham. A look at Instacart, 5 days of trading, 4 of those days down, 4 of those days is traded below its $30 IPO price, and today it could potentially close below that level as well. Coming up here, a conversation about the auto supply chain and some of the disruptions coming from the UAW strike. That conversation coming up after the break in our Wall Street Week Daily segment. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment with David Weston, who joins us every day around this time. And David, there's been so much talk about the United Auto Workers strike and the effect on Ford, GM, and Stellantis. But we forget there's a whole ecosystem of parts makers and other companies that are also being affected.
Exactly. In some ways, those automakers are just the tip of the iceberg. There's a big iceberg down below the water. And to take us through that supply chain issue, we welcome now Bindia Vakil. She is Resilink's CEO. Welcome back, Bindia. It's great to have you here. So give us a sense of just how many ancillary businesses there are feeding into the auto industry that are either now being affected or will be.
David, there are tens of thousands. And let me give you a little bit of a snippet on Resilink and why we have this unique perspective into the global supply chain. Resilink monitors global supply chains, supply chain disruptions 24/7 in more than 100 languages. And more importantly, we map these supply chains down multiple tiers deep, all the way down to the small suppliers and raw material providers that are vital to supply chains operating. Put these together, our customers, including the automakers, work with their suppliers multiple tiers deep to navigate through these challenging disruptions. So as you can imagine right now, a small disruption at the OEM level really ripples through the supply chain as you go to the suppliers and suppliers globally. So this is not just limited to the United States and suppliers here. Globally, when demand grows up, as it did before the strike went into effect, there was what we call a bullwhip effect, where suppliers saw an increase or a spike in demand. And now as the demand is dropping, as the strike expands to the supplier, this looks like a manifold reduction in demand. And these suppliers can be everyone from a small mom and pop shop that does some tooling tooling, or it could be a large company that manufactures massive systems.
So let me pick up on those small mom and pop shops. In your map, as you look at it, how many of these suppliers are, I guess they call them tier 2 or tier 3 suppliers rather than tier 1, because they can be very small, like family-owned businesses, as I understand it.
Yeah, absolutely. I mean, in the automotive supply chain, we've mapped down 4 to 5 tiers deep, and we see everything from semiconductor, which obviously shows up in our cars, everything we do. So some of that supply chain at the 3rd and 4th tier looks fairly similar to a typical high-tech or consumer electronics supply chain. But then when you look at things like seats and threads, I mean, you'll see the seatbelt thread makers, and you will see the upholstery, and, those small parts can come from suppliers that aren't terribly sophisticated. And there's an ecosystem of suppliers around each of those factories as well.
Yeah.
So it's a very complex and fairly networked industry.
I am curious about the potential longer-term changes. The last time we had a major supply chain disruption, of course, born out of the pandemic, we did see some major structural changes that took place as everyone sort of had to reassess what their supply chains looked like. Do you think if this does drag on, we'll see something similar play out for the automakers?
Absolutely. In fact, right now, there are 5 mega trends already in play why supply chains are in a state of flux. 1 is extreme weather. 2 is the demographics and labor disruptions, which, by the way, is one of the top 5 reported disruptions in our database. The 3rd is geopolitical shifts. 4th is ESG, and 5th is cybersecurity. So these are 5 mega threats, if you will, that have already caused supply chains to either shift, move around, do things differently, cause suppliers to change how they operate. So they're long-term, specifically to the labor strike. Yes, we see a lot of our customers on the Reslink platform assessing suppliers, really understanding where they have unionized factories and those types of dependencies to manage this in a more proactive way.
And we should point out, too, I mean, as they're doing that, it's one thing to sort of look at the supply chain through the context of the cars that you're making now. But if you believe in, I guess, what the future is supposed to hold, where we all move to renewable energy vehicles of some type, how much does that change the calculus?
It changes quite a lot. The electric vehicle supply chain looks very much almost like a networking or switching product, but on wheels. So it's a very different type of, there's a lot more automation. There's a very different type of componentry that goes into those. It's complex. So the kind of, plus there's a tremendous amount of AI and AI-driven automation that is coming our way on the EV side as well. So there's a lot changing, actually, as we speak.
But Dia, to come back to this strike right now, how long before it causes permanent damage to the supply chain? Because I have read some accounts that some of the smaller suppliers actually do not have enough cash on hand. They don't have the resources to go very long into the strike. Could we do permanent damage to the supply chain?
It is on a lot of our customers take care of their suppliers to some extent. We see customers looking at which suppliers are highest impact to revenue, for example, and then extend them lines of credit. This is something we recommend companies do as we speak. Really monitor which of your suppliers are potentially in financial distress risk. Assess their financials, have candid and collaborative conversations with them. And then there are several things we recommend our customers do. And many of them are doing that right now.
Okay, Bindia, always good to have you with us. Really appreciate it. It's Bindia Vakil of Reslink. So, as you know, there are a lot of households in the United States who don't have that much money saved up, and you wonder about a lot of people out back in my home state of Michigan, Ohio, Missouri. They're under some stress right now.
Yeah, I've seen some of the economic calculations for exactly how this could affect those individual households if this goes on for a longer period of time, and it's pretty sobering.
Yeah, right now it sure looks like it's not ending anytime soon. Unlike the Writers Guild, you got the Writers Guild strike taken care of. Congratulations.
In theory, congratulations. Thanks. Now we just got to work on the auto strike.
No, exactly. We've got a long way to go. So tomorrow we're going to hear from Raj Cohen, Senior Chairman of Sullivan and Cromwell, about the moves to regulate the largest non-bank banks. There are some big ones like BlackRock who are really concerned about that. And then on Friday, Rashir Sharma of Rockefeller International joins us on Wall Street Week. We're to talk to him about investing in China. A lot of it's not being done right now. And if it's not being done there, where's it going to go? That's all coming up at 6 p.m. Eastern Time on Friday on Wall Street Week.
And be sure to check that out. You could also check David out every day at right around this time here on The Close for our Wall Street Week daily segment. Here on The Close, we're rounding out into the final hour of trading here on a soggy Monday afternoon, picking up pretty much where we left off last week, which is the market still searching for some degree of direction in the face of Treasury yields that continue to drift higher on the long end, higher on the short end, and right now a revaluation of some of those multiples that have left a lot of folks wondering whether there was any room left to run for U.S. equities. Romaine Bostick and Katie Greifeld counting you down to the close. This is Bloomberg. Almost 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld.
And we take a look at a market that's still searching for direction here, Katie. A mixed day here for most of the broader indices, but that's coming off what, of course, was an absolute awful week last week.
It was really bad.
Yeah.
We're talking about the worst week since about March for the S&P 500 when we had that banking crisis, if you will, unfold. So it makes sense that we're left a little, I don't know, tired today on this Monday?
Yeah, a little tired here because everyone thought maybe the Fed was behind us. I think we sort of learned a hard lesson last week where we learned that the Fed is still out in front here. And now, of course, a lot of people obsessing about the potential for a government shutdown. We're still relatively unchanged on the day. And I guess the fact that we're in the green on a couple of the key indices, maybe that gives some people a little bit of hope here. But take a look at the bottom of your screen there, Katie Greifeld, 465 and change right now on your 30-year yield.
I thought you were going to go to Bitcoin, which is also down today. But yeah, all the action in this market, even when you put in crypto, has been in the bond market. The volatility that we've seen, mostly yields higher, has just been pretty breathtaking so far.
And it makes you wonder if the volatility is going to pick up. Flip up the board real quick here because I do want to just talk real quickly about the government shutdown. We talked about it a little bit earlier here, but take a look at the this chart here. This is basically the MOVE index, bond price volatility, and the red lines are the last few shutdowns that we've had, or at least the brink of shutdowns here. And that volatility does start to pick up because, of course, this has a material effect on, obviously, our federal finances, but also the ability of the Treasury to continue issuing new debt.
And, of course, the countdown is on for that Saturday midnight deadline. We'll see what happens over the next few days. But let's talk about some of the biggest movers today. I want to highlight Amazon. This is a really interesting story. You can see the Amazon shares up 1.8% after news broke that they're going to invest as much as $4 billion in Anthropic, basically one of those hot AI startups. The plan here is that Anthropic is going to move most of its software over to AWS's data centers, and also it's going to use Amazon's homegrown chips to train its models.
Interesting. This will be for good, right? Not evil.
It'll be good for Amazon, theoretically, and good for Anthropic. You can see that's giving a lift to those Amazon shares. Let's also talk about Open Door.
Yeah, this is an interesting story.
Yeah, not having a great day. Of course, Citi coming out, cutting the price target to do $2.70. It's a reflection of basically housing macro headwinds that we've been talking about. That's going to keep existing home sales below historical levels, according to Citi. Shares off on Open Door by about 5.5%. And we should probably talk about the, I was going to say the strike. I have to specify which one. The writers' strike. Of course, we're finally getting an agreement between the studios and the writers. I wanted to take a look at.
And I assume the shares are rallying on this?
No, they were, and now they're not. Warner Brothers Discovery's off by 3.5% or so.
Yeah, it's an interesting reaction. In fact, I think the last time I looked, Netflix was really the only major studio that was actually higher in the day.
Yeah, I'm hoping someone can explain that reaction to me.
Yeah, all right, well, stick with us. We'll try to get you that explanation 1 hour away from these closing bells. Our cross-platform coverage, counting you down to the close. That coverage, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, and our partnership with YouTube. Happy Monday, Carol and Tim. Interesting day for the markets, not so happy at all. And some interesting data that we've been writing about here, some Federal Reserve data showing that, well, the amount of money in the pockets of consumers right now, not quite as flush as it was in the past.
Yeah, and that's kind of true for everyone, whether you're the richest of Americans or the poorest. But what's interesting is this Fed survey of household balance sheets. Basically what they found, the richest 20% of Americans are doing the best. They still have some excess pandemic savings. It's a complicated chart, folks, that's out there for YouTube TV and, of course, our streaming service. But that's what it says. The richest 20% of Americans have excess pandemic savings. They have not run out completely, but they now have less cash on hand than they did when the pandemic began. The bottom 80% of households by income, bank deposits, and other liquid assets were lower in June this year than they were in March 2020 after being adjusted for inflation. So they're getting hit hard.
Okay, what about the next 40%, the middle class? They saw their cash savings drop below pre-pandemic levels in the last quarter. So, Romaine, we're talking about this because for a couple of years we've been saying over and over again, okay, what about excess savings, powering the consumer, powering the economy? If that dries up, what happens to the economy? Because, well, consumers power this economy.
Yeah, I never quite bought into that. I mean, I know that the aggregate data showed that, but it just seems that when you looked under the hood, there was a huge concentration of those savings amongst a small group of people in this country. And when you looked at everyone else, at least anecdotally, they were already struggling. And we're talking like months ago when we were having this conversation. So I can only imagine what some of those balances look like today.
Well, let's talk about another potential pain point. Of course, we're talking about the child care cliff. This is when those pandemic-era subsidy for U.S. child care providers expected to expire on September 30th. And there's a great column by our Sarah Green Carmichael saying that it's estimated about 3 million children could lose their spots, and thus that's why we're calling it this child care cliff.
Yeah, we spoke last week with Catherine Edwards when I was down in D.C. about this. She had testified. There was a hearing last Wednesday, I believe, where she testified about this. This is a big deal here. We're talking about real money that went into people's pockets to pay for child care, and it was already kind of set to expire one way or another. But now, of course, with all the infighting over the government shutdown and whether there'll have to be some compromises made in order to appease those that far right-wing faction of the Republican Party, it makes you wonder if this will ever even get renewed.
It's amazing, too, that we still can't get this right? So many working Americans, they talk about when it comes to struggles, it's taking care of kids. It's either you can't find the people to do it, or it's also really, really expensive. What's also interesting, and I think that kind of stands out from this opinion column for me, is that when you have these child care deserts, maternal workforce participation really takes a hit. So essentially, if you can't find folks to take care of kids, it's women who get pulled out of the workforce. And they made incredible strides and advancements coming out of the pandemic when we saw a lot more flexible work situations coming out, Tim.
It's not rocket science. If you can't find somebody to take care of your kid, you're not going to be able to go to work. Here was something that was pretty shocking that I found in that story. The federal threshold for household income in order to say that childcare is quote unquote affordable, 7% of your household income. That is like, find me where you can get childcare for 7% of your household income.
Yeah.
Not in New York City.
Yeah. And to Carol's point, too, I mean, there's just so much data and so many about the correlations between having women in the workforce and having viable child care alternatives. And the fact that we're still having this debate, particularly in a political spectrum, is just mind-boggling.
Yeah, you keep hoping we're going to keep moving forward and learning, but we continue to slide back. All right, guys, we're going to continue this discussion, and we're going to also talk a little bit more about the markets and take you down to the close on this Monday. Join us in less than 60 minutes' time. We're going to count you down to the close on radio, on TV, on YouTube, and of course Bloomberg Originals. Join us for Beyond the Bell at 4 p.m. Wall Street time.
And we continue our markets coverage right here on the close. About 50 minutes until we get to those bells, and all the focus isn't on equities, it's on treasuries. Those yields marching higher, hitting multi-year highs today as expectations that the Fed will maintain higher for longer take hold and the supply of treasury debt increases. Gene Tenuzzo joining us right now, global head of fixed income over at Columbia Threadneedle Investments. And Gene, let's just start off with the elephant in the room here. I'm looking at 13 basis points higher today on the 30-year yield, similar on a 20, 10 basis points on a 10, and even the 2 and 5 year moving higher as well. Gene, when does it stop?
Well, that's a good question, Romaine. I think the market has taken the comments from Powell as meaning that the longer end of the curve really needs to come higher. And there doesn't seem to be a near-term catalyst to abate that move at the moment. But I think longer term, the market kind of missed the plot after the Fed meeting last week. The single most important thing that happened in that meeting is that we're getting even closer to being done talking about rate hikes. And 18 out of 19 members that put their forecast down said basically one more hike or fewer, and then we're done. And I think that's the most critical thing here. I think the long end of the curve, especially that 30-year point, the risk premium there can continue to bounce around, particularly as we see deficits and Treasury supply continue. But I do think we're going to see more stability at the front end of the curve as we go forward.
Is that where investors then gravitate to, Gene? Because there's been some folks on this program, including today, that says maybe there is an opportunity a little bit further out in duration. Are you seeing it?
We think duration overall is attractive. If you look at historically, when the Fed reaches that peak in the rate hike cycle, the next 12 months of returns are very attractive for high quality bonds. We think we're at that point, and at the worst case, we're 5 weeks away from that last rate hike. And I think going forward from here with a 4.5% yields along most of the yield curve or higher really sets you up for nice returns. Our preferred area would be the 5-year part of the curve to avoid that volatility at the long end that could come from sort of uncertainty around risk premium, especially with a government shutdown looming.
Well, Gene, something I'm still scratching my head over is why we're seeing these huge moves at the long end of the yield curve. You think about when you look at a basis point level, what we're seeing in terms of the 10-year, the 30-year, what's actually driving that?
Well, I think there is some law of gravity in terms of how inverted the curve will get. And now we're at a 5.25% to 5.5% funds rate with the potential to go yet a little bit higher. I think if you get up to 5.75 with the top end of the range for the Fed funds rate, having a 10-year yield 100 basis points below that is reasonable, but hard to go much below that until we see a material change in policy. So I think we're going to be stuck in this range where the front end of the curve is kind of dragging longer maturities higher. But I think we're getting close to the end of that move, honestly. And I think, at the end of the day, it's going to be changes in the economic outlook that really are going to drive Fed policy. And I think now, for the first time in 2 years, we're getting to a point where those risks for the bond market are two-sided instead of just one-sided with yields moving higher.
Well, Gene, there was a really amazing chart out of Deutsche Bank last week, actually, that plotted the 10-year Treasury yield back to 1790, so over 200 years or so of data. And the average over that time span is 4.5% for the 10-year Treasury yield. But you think about the economy that we had in 2007 when we were last here, what we had in the 80s, the 90s, and in the 1700s or so. Is this economy built to withstand 4.5% 10-year Treasury yields?
Yeah, that's a good question. My Bloomberg terminal doesn't go back quite that far, but if I look at the data that we have versus what the Fed is projecting, basically GDP growth is already there at around 2%, which is consistent with their long-run forecasts. The unemployment rate, just below 4%, is already consistent with their long-run forecasts. And even the inflation rate, if you strip out housing, CPI ex shelter is already at 2%. So I think we're very close to that equilibrium economy, and they will be able to make meaningful changes to the funds rate when the data change. And I think your previous guest was talking about what some of those sources could be, but I actually think we're not that far away from an equilibrium economy. And now if you weave in some risk to the downside, I think rates can go lower. I wouldn't anchor on a 300-year average in terms of determining where 10-year rates should be now. What we're looking at is the economy changing? I think the simplest way to look at that is looking at the housing market, where existing home sales are at recessionary levels because of what's happened to interest rates.
Yeah, interesting, too. Why do you think, then, we're seeing so much volatility then in the yield space? Is it because of just a difference of opinion about where we go, or is there something maybe a little bit more consensus-oriented?
I think it's a difference of opinion, and I also think there's a global divergence going on here. And it kind of goes back to the old Alan Greenspan comment that the U.S. cannot continue to be an oasis of prosperity. And in the current environment, we're seeing weakness in China, we're seeing weakness in the U.K. and Europe. And the question is really, when does that come to the U.S. and start to outweigh some of the growth momentum that we've seen here? We think those factors will start to come into more balance as we go over the next few months.
All right, Gene, really enjoyed this conversation. Gene Tenuzzo, Global Head of Fixed Income over at Columbia Threadneedle Investments. Thank you for your time. Now, coming up on the close, the plan to turn the U.S. back into a semiconductor powerhouse, how the government is calling on former executives from Goldman Sachs and KKR to help lead that strategy.
And one of the biggest decliners today is Alcoa, an abrupt change at the top of that company, the largest U.S. aluminum producer, naming a new CEO as it deals with operational and permitting setbacks in Australia.
And a big conversation coming up. Usher is confirmed as
he's going to be here?
No, but he's going to headline the 2024 Super Bowl halftime show. The Grammy award-winning singer calling it the honor of a lifetime.
Is Kim Kardashian performing as well?
I hope so. I just want to talk about Taylor Swift, though. In any case...
Taylor Swift, is she performing?
No,
this is going to be some halftime show.
We have
all
a lot
that
to
and
talk
more
about.
coming up in a bit. This is Bloomberg. With less than 44 minutes until we get to the closing bells here, the Magnificent Seven trying to do what has made them so magnificent. Apple, Nvidia, Amazon higher here on the day, but you see somewhat fractional gains, and with some of the other cohorts down on the day here, the net effect is a market that's relatively unchanged. A lot of big cap names are in the red, including Microsoft, which has taken a leg down just over the last few minutes. Some of the consumer staples companies, as well as consumer discretionary names, also moving lower here on the day. A big part of reason for the agitas, what you see right now in the middle of the screen here with the 30-year yield right now around 4.6. That's 13 basis points higher than where we were just on Friday. The selling that we're continuing to see on the long end of the Treasury curve causing people some concerns as about what's actually being priced in. Is it higher rates, or is it more about economic conditions, or maybe a bit of both? The Bloomberg Dollar Spot Index trying to reassert itself once again here. Bitcoin not getting any love, and I guess if you're looking for a respite from some of the big moves that we had seen in the energy space, you at least got it today. WTI crude back below $90 a barrel. Let's get Abigail Doolittle into this conversation, as we do every day at this time, for our Options Insight segment. And Abigail was just taking a look at the VIX here, up for, what, 7th of the past 10 days here, camped out around 17. A big question is, why is it continuing to move higher?
Well, all of that uncertainty you were just talking about, Romaine, whether yields, if that's higher for longer, or it has something to do with the global economy. And of course, we have this China weakness. We also have action in the yen, all of it coming together. And I can't think of a better person to discuss the intersection of these topics than Samantha LeDuc, founder of LeDuc Trading. Great to have you with us, Samantha. And so Romaine is talking about the VIX. When I take a quick look, a simple look at the chart, it looks as though it could pop very quickly above 20, which would suggest there will be more volatility for stocks to the downside, maybe even significantly higher. What are you seeing there?
Definitely dollar and yields are making the weather, right? So when we actually had back in July 31st a very large Treasury issuance, August 1st was when we started to roll over in markets. So underneath there was definitely already breadth breaking down, and there was net selling. But yields were really the tell, right? We had this issuance and it was large. Yields started moving higher with the dollar, and they make the weather. So right now, I'm not really liking these odds. VIX has definitely percolated because we needed a trigger, which was FOMC, right, last Wednesday. And as soon as Powell got off the podium, we obviously had the volatility because he obviously made the call, basically, that the Fed funds rate for 2024 was going to increase from 4.6% to 5.1%, and basically pulled out 2 cuts from the market that the market had been pricing in. So the dollar and yields are at a very, very important level, 106 on the Dixie, 4.5% in the 10-year. And that means above that level is actually even more volatile. And I'm actually looking at a gamma level in the market right now, and a JP Morgan collar structure that says we could actually tag 4,200 by Friday.
Yeah, well, it's interesting that you're bringing up that issuance of treasuries in late July, because what I've been talking about or thinking about was that Fed meeting in July where the Fed indicated that they're not going anywhere. They confirmed that that's last week, but that makes a lot of sense what you're talking about with that issuance, given the fact that we've seen the dollar index, a currency, go up about 5% over that time period, really pretty unheard of. So, you know, when we connect rising yields, rising dollar to the VIX, to volatility, what is it? What is the connection there? What makes it so unsettling for traders? Is it just the money coming out of the system?
Oh, Definitely. We have liquidity that's leaving versus coming in, but we also have a structure called negative gamma. So positive begets buying and negative begets selling if we trigger particular levels. And there are CTAs and other quants that basically have price insensitive buying and selling. We have right now what's called kind of a put wall, which is this kind of 4,300 for SPX. If we go through that, that triggers even more outsized selling. We happen to have a JP Morgan caller, which happens to be a very large hedge. It's rolled every quarter. Sometimes it works, sometimes it doesn't. But there is a very stickiness to some of these levels that helps pin the market or pull the market. In this particular case, we have that caller, which is at 42.10 for this September 29th. Which is the quarterly expiration for September. It looks very much like the market wants to go there.
Yeah, very quickly, Samantha, when I take a look at a chart of the S&P 500, we did go below one level that suggests support is giving way, that there is a trapdoor there to some degree. What would it take to go below 4,200, and how much further down would we go if we were to do so?
Well, one thing that I'm looking for that's an economic data point this week, I think all eyes are on GDP revision, believe it or not. This is this Thursday, and one of the things that the Fed has managed to do is obviously remove two potential Fed cuts in their last week FOMC meeting. This particular revision downward in GDP could show that one of the reasons they removed the cuts, by the way, was on the strength of the economy. Right. That revision this Thursday could actually undo some of that, which would be good for bondholders, right? They're suffering terribly. Yes. So it could soften yields. It could put a short-term duration bid in bonds and equities, but more importantly, is a slowing backdrop for the economy. Yep. Bullish equities. That's the big question.
Yeah, absolutely. Well, thank you so much for weighing in on all of these topics. Very helpful, as always. Samantha LeDuc, founder of LeDuc Trading. Thank you for joining us for Options Insight today. And from New York, this is Bloomberg.
Well, Usher is next up for the Super Bowl halftime show. The 8-time Grammy-winning singer will headline the big show in Las Vegas on February 11th. And remember, Romaine, back in 2011, he was a compliment to the lead act. He's never actually headlined the show. So
yeah. Well, about time. I mean, this should be good. It's generating a lot of buzz. I don't know if you've seen the promotional videos.
Of course.
But they have a great one where they're taking a clip from one of his old videos and they're putting it up with Kim K and Deion Sanders and a few other people, basically calling him, as you see there, and letting him know that he's going to perform at the halftime show.
I saw the Kim K one. I didn't see all of the other ones.
Yeah.
But yeah, it is kind of surprising that he's never done it before. Of course, he first really broke onto the scene in 2001. I mean, Usher has been a household name for so long.
Yeah. So, well, this is fitting, right? Because they only put, like, older, sort of people who've been around here. Now, I know you're a big football fan. Bigfoot. So I'm sure you were watching this weekend when apparently someone famous decided to show up at this Kansas City Chiefs game.
I wasn't watching, and then I tuned in because rumors have been circulating.
Did you get like alerts on your phone?
I did, actually. Okay. Anywhere you went on social media, it was all about Taylor Swift was at the Chiefs game. She is officially confirmed dating Travis Kelce. Huge news. You can see her there with the Kelce mother.
Yeah.
This is a little bit interesting because Taylor Swift is from the Philly area. She's from Pennsylvania. She should be an Eagles fan.
Right.
The other Kelce brother, of course, I don't know if I should call him the other Kelce brother, but there's a Kelce brother on the Eagles as well. So a little bit of a
But she decided not to date him. Who's he dating?
He's married, actually.
Okay.
I know that because sometimes I listen to their podcast.
Well, that's interesting. Yeah, as you point out, too. I mean, the Chiefs just absolutely whooped the Bears for that game. It'd be nice.
Can you imagine if he hadn't, though? If Taylor Swift came and he just...
I want Taylor to start dating somebody on the Chicago Bears who are 0-3 right now. Maybe she would get that too.
I don't know. Maybe she's into athletes now.
Yeah.
In any case.
Is this the new era? Are we going to get an album about this?
The albums are going to be fantastic. This is Bloomberg.
This This is the countdown to the close. About 30 minutes left to go on a somewhat tepid Monday in terms of trading action, Katie.
A lot of indecision if you take a look at the benchmark. If you actually dial back down below, also not too much conviction. You can see there's more green than red, but we're talking about pretty small moves. Energy, though, at the top of the pack is up more than 1%, followed by materials, consumer discretionary. You go down the list, again, pretty small moves until you get to the bottom of the pack. Utilities off by about 0.4%, and staples, interestingly enough, leading losses today, off by about 0.7%, Romaine.
Yeah, interesting to see 100% of the members in that energy index higher on the day. As far as a Magnificent Seven, a bit of a mixed bag for them. Amazon, though, having a great day, up about 2%. Remember, this has actually been one of the relative outperformers in that space for quite some time, even though it's had a somewhat dour September here. But keep an eye on that space and keep an eye on the big Hollywood studios. Of course, our reporting earlier today about a potential agreement between the writers and the Hollywood studios. Netflix right now is probably the only stock amongst them that's really doing well today on the back of that. The rest of them are either lower or somewhat unchanged. Paramount down about 0.4%. And keep an eye on Brainstorm, down 39% right now. This after the FDA released some documents that appeared to show that they had some doubts about this company's ALS treatment that it's been working on. Remember, this is a biotech with basically one product in the pipeline. That product doesn't get approved. Well, it's look out below here. And Chef Warehouse, which has actually been one of the worst performing stocks out there for quite some time, getting an initiation at UBS, those shares higher by about 2%. Of course, we go back to some of the broader concerns in the market, and by the time we get to the end of the week, this is going to be a chart that a lot of people talk about, the debt to GDP ratio and our fiscal situation right now. That is the debate playing out in Congress right now, at least if you believe in earnest that that is truly what they're talking about. But the net effect of it is, well, a potential government shutdown. The government, of course, here in the U.S. has to approve a new budget by the end of this fiscal year, which is September 30th. And, well, as we stand right now here on whatever it is, September 25th, still no deal, Katie Greifeld.
Let's go from debt to chips, because Commerce Department Secretary Gina Raimondo is pulling together a team of former Wall Street executives to help the turn the U.S. back into a semiconductor powerhouse. Let's break this down with Mackenzie Hawkins of Bloomberg News. And Mackenzie, set the scene for us. Why is the U.S. really putting their muscle behind this effort?
So the U.S. is engaged in basically a global war over chip technology. Now, chips are the tiny electronic components that are in everything from electric vehicles to nuclear missiles. And the U.S. used to produce the chip technology and make chips here, but over the past 40 years, all of that production has pretty much shifted to East Asia. And now Washington is very concerned about China's rise in this technology, particularly with military applications. So there's a massive government subsidy effort to convince the world's biggest chip makers to build factories and produce chips here in the U.S.
This has sort of been an effort that's been going on for quite some time now. It's interesting, Mackenzie, to see some of the dollar figures attached to it, and as well as the folks who have to deploy this cash. But there's been some concerns here that even when you look at the aggregate amount that the government is putting on the table, that for some of these companies on an individual basis, that's still just a drop in the bucket.
That's correct. That's one of the central challenges of the CHIPS and Science Act, which is the marquee semiconductor policy that was signed into law just about a year ago. The government is dealing with just over $50 billion in subsidies, and that's broken down into $39 billion in loans and then a pool of around $75 billion worth of loans and loan guarantees. And that's really a drop in the bucket. It's about just a little bit more than a year's capital spending by some of the biggest chip makers. And the U.S. is trying to convince global technology giants like Taiwan Semiconductor Manufacturing Company, like Intel, which is a U.S. company, like Micron, to build fabs, which are chip production facilities that cost $20 billion or more. And so the Commerce Department has some really difficult decisions ahead over how they're going to divvy up this relatively small pool of money between more than 500 companies that have expressed interest in the fund.
Well, Mackenzie, that's what I'm interested in. What does due diligence on the government's part look like here? How do they make sure they're investing in the right companies?
I mean, that is the central challenge that has plagued Washington's efforts at industrial policy in the past. And there are examples that folks here point to, like Foxconn and like Solyndra, where the government has bet big on a company that has gone belly up. And the biggest concern is making sure that doesn't happen here. And so the Commerce Department, led by Secretary Gina Raimondo, has pulled together a team that includes some folks from Wall Street, includes veterans of Goldman Sachs, of KKR, to try to structure deals that put commerce on a level playing field with companies that hold all the tools of the trade. And they've said that they're going to give out the money in tranches. So once they reach an agreement, we don't know when those are coming, at the earliest, probably later this fall. They'll be dispersing the money over time, contingent on the companies meeting benchmarks related to workforce development, production capacity, and getting these factories up off the ground.
All right, Mackenzie, great reporting. Really appreciate your time. Our thanks to Mackenzie Hawkins of Bloomberg News. And it's an interesting question, Romaine. I mean, I guess that's why you put some of your very big brains in a room together to try to figure out where to actually put this money.
Yeah, and hopefully they get it right. I know everyone always likes to focus on the failures. Obviously, Solyndra, at least one of the big ones that people made a big deal out, but you forget about the success stories, including, of course, Tesla. You forget about the bailout of GM. And, of course, you forget about, if you really want to go back in time, all that money that was put into the Human Genome Project and all those biotech and the medical companies that came out of it, or into the space program and all these defense contractors and other sort of component makers that are thriving today.
People never forget your failures.
Yeah, so that's my list for you, Katie Greifeld.
That's a good list. I mean, it'll be fascinating to follow this, and we'll see where that money actually goes. But coming up on the close, before we get there, we're going to be talking about a sudden C-suite change. It's putting pressure on shares of aluminum giant Alcoa. We'll get into it next in our Stock of the Hour. That's up next. This is Bloomberg.
Time now for our Stock of the Hour, a look at Alcoa. Shares of the aluminum giant under pressure after announcing the sudden switch in CEOs, has Wall Street wondering if there's a little bit more to this story. The company naming William Oplinger as its new head, succeeding Roy Harvey. Joe Doe joining us right now. He covers commodities for us here at Bloomberg News. And this seemed to take a lot of people by surprise, which is never really a good thing for the leadership of a company. What do we know about the reasons for the departure?
At the moment, we're not really clear why now. Listen, I mean, Roy Harvey had been the CEO ever since the company split into two back in 2016. So he's been there for, 7 years now. There had been talk over the years that, maybe somebody else new would come in, especially because Roy Harvey was the guy who they expected to cut debt, bring down the pension liabilities, and turn the commodity company into a more efficient company. He did all those things. Now, Bill Oplinger comes in. Bill is very well known at this company. He's been there since March of 2000. He's been the CFO. He is the guy that when people have questions, investor class, some really deep in the weeds things, they go to him. Bill's the guy that oftentimes was going to many of the conferences. So in that regard, Bill becoming the CEO is not something that would be totally unexpected. But again, there was an 8K filing that was filed yesterday. It was published this morning. There also was a mention of severance for Roy Harvey in there. And it does seem to have taken a little bit of the market off guard in that.
What theoretically is he being brought in to do?
Well, listen, a lot of people have said now that Alcoa has been a little bit of a sleepy company, right? There haven't been a lot of major acquisitions, and not that investors have been asking for that, but there's not been real growth that you've seen in the company. Sure, they had a massive bump in the stock back in 2021, right? But that's also because that was the commodities rebounding from the pandemic shutdowns. You've seen some of their competitors go out and get more involved in the battery metal space. You've seen some of them get more involved in scrap, right? Scrap is becoming more and more profitable business. You turn that and remelt it into new material. Alcoa just hasn't been that kind of person. So again, it's too early to tell what exactly they're going to expect them to do next, but these are the kind of questions that have been coming up from investors.
Yeah, and not to dump on Oplinger at all, but I mean, he's been there for quite some time, so it raises the question, what type of innovation can he bring if he's basically been there at the hip of this CEO and, for that matter, previous CEOs as well? I am curious, I mean, you know this company. I mean, this was a premier U.S. company a few years ago. It was a member of the Dow. It was, I mean, famously, it was always, the first company to report earnings, and now no one really thinks about it much.
Yeah, I mean, Alcoa has become the commodity producer. Yeah. They make aluminum, right? The jets and car part businesses have long been gone.
To Arconic
and Roy Harvey, I mean, one of the things he did well that investors liked in those first few years was he just made Alcoa a boring commodity company. And it turned out that actually if you invested in Alcoa for the first 2 years, you saw your share price double, right? And so investors were happy with that. But that's 7 years ago, right? And I guess it does bring up a good question of what are the big things that are next for Alcoa? Listen, they're very much talking about green aluminum and everything else. But it'll be tough to see.
So Alcoa looking a little bit sleepy here. Are there any exciting aluminum companies? What do their peers look like?
Well, I think the aluminum space, they're all trying to figure out the next step. How do you make aluminum completely without carbon, right? Alcoa has a joint venture right now with Rio Tinto that Apple is involved in. I wrote about that 2 years ago, right? And how much progress have you seen in terms of them scaling up commercially? Not a whole lot. And I think the whole industry is trying to figure out that next step. And of course, everybody's just raving about battery metals, nickel, rare earths and everything else. Aluminum is aluminum. Steel is steel, right? These we will always need for their various commercial inputs. But in terms of the growth, it seems that, most of these companies have figured out their markets at this point.
All right. Well, Katie Greifeld still on the hunt for an exciting aluminum company. Joe Doe, who helps cover this sector for us here at Bloomberg News. And we want to actually continue here in the commodity space because the American Security Summit, it's underway down in Oklahoma City. The CEO of Chevron, Mike Wirth, he spoke from that event about energy policy and the impact of EVs. Take a listen.
When I hear somebody that starts to rule things out, I'm hearing somebody who's not serious about energy. There is no silver bullet in here. EVs are great, but EVs are not going to be the silver bullet. They're a part of a very complex solution set.
And that was the CEO of Chevron, Mike Wirth, speaking a little bit earlier, Katie Greifeld, out in Oklahoma City. And we've heard this from a lot of executives who are kind of in this space, or the fossil fuel space, if you want it. They're obviously trying to balance out their legacy business with what I think most people agree is going to be the future. Now, whether that future is 5 years from now, 10 years from now, or maybe 50 years from now, no one really knows. But clearly he wants to see maybe a little more balance in the interim.
Yeah, you think about what the Biden administration and other administrations have put their muscle behind. It's EV production. And it was interesting also from Mike Wirth saying that if you look at U.S. oil production, it's being held back by inconsistent energy policy, which is what you would expect him to say. But, I mean, it's a point that plenty of people have made. Plenty of people have made, and they've been making that, I feel like, for the last 20 years now. And you know, it is what it is, and I don't think it's going to be any different, right? I mean, if you get a new president in another year here, how is that policy going to be materially different from the policy we had under this administration or the previous one? That's the interesting question. How much does the president actually matter here? All right. Well, know who matters, Katie Greifeld? Tell me. Our next guest here. We're counting you down to the close with about 15 minutes to go. Ed Clissold going to be joining us over at Ned Davis Research. Stick around. We'll be back in a moment. This is Bloomberg. This is the countdown to the close. I'm Romaine Bostick. And I'm Katie Greifeld. 10 minutes until we get to those closing bells. Katie Greifeld, and a mixed day for the markets once again, coming off what was last week one of the worst weeks that we've seen since March, at least for the S&P 500. Right now, holding on to fractional gains here on the day, about 0.2% for the Dow and the for the S&P and the Nasdaq here. But there's still some concern here about what we're seeing in yields, 4.5 right now on the 10-year. Well, let's get into it now with Ed Clissold. He is Ned Davis Research Chief U.S. Strategist. Ed, it's great to have you with us. I'm curious, when you think about what's happening in the bond market, you think about what is happening in the stock market, how related are those two markets right now?
Oh, it's very related. Yeah, with yields across the curve to the highest levels in several years, in some cases a couple of decades, investors now have to ask themselves the question, are there reasonable alternatives to equities? And so if you were to say, look at the earnings yield for the S&P 500, so inverse the PE ratios, or PE of 20, earnings yield of 5, stocks are actually more expensive than cash. So you really have to try to find companies that are going to grow very quickly to justify owning a risky asset like stocks instead of just sitting in cash and collecting a risk-free 5.5%.
And what do you think the tipping point was? Because it feels like every couple of months, maybe the stock market starts to really be driven by what's happening in the bond market. But when you think about this latest episode, what do you think the actual catalyst was that now we're in this situation where it feels like the bond market is very much wagging equities?
Well, I think that the investors are starting to figure out that the Fed is serious about higher for longer. And so rather than what the expectations were for maybe another hike and then several cuts next year, now we're starting to price in, either a soft landing, which means rates will be higher for longer, or the other side of the coin, which is the economy doesn't do so well and the Fed is cutting because all sorts of bad things are happening. So, the market just was living in a little bit of a Goldilocks that probably wasn't going to be there forever, of inflation coming down enough for the Fed to cut rates without causing recession. That's a very, very thin needle to have to thread.
I am curious about some of the technical levels, Ed, that we've been seeing in the equity space. A lot of talk about at least the S&P and the NASDAQ breaking below that 50-day a couple of weeks ago and then the 100-day moving average, and whether there's a trend line here that is now starting to point down.
Yeah, I think there are some technical levels that are starting to be breached. They still are fairly short or intermediate term. And we're in a seasonally weak period. We had such a great start to the year. The first 7 months of the year were the best since 1997. So a little bit of a pullback at this point, still within the context of a long-term uptrend. But what we do want to watch, Romaine, is to see if those long-term technicals break down. For example, percentage of stocks above their 200-day moving averages. That's looking back several months. It's down to about 45, 44%. Not great, but usually it needs to get into the low 30s before you'd say this is a top. And furthermore, what I'd say is usually tops are processes. So if this is the first part of a top, then we'll probably have a few waves before a downtrend gets started in earnest.
How much has seasonality played into some of the weakness that we've seen? I remember there was a lot of discussion about how September is historically a bad month, and with just, 4 more sessions until the end of the quarter here, I'm just looking at the month-to-date losses, the quarter-to-date losses, and it's pretty much consistent with that.
It is. And, some years it matters a lot. Some years the market tends to find a different rhythm. This year, it's actually moved in the seasonals in lockstep. But it's because of the macro backdrop has made sense. And we hit a point in the summer where we had priced in a lot of the good news, a lot of investor sentiment data that we look at, surveys of investors, but also positioning of a lot of investors was pretty optimistic. We've backed a lot of that away. Our composite of short-term sentiment has dipped into pessimism, not quite to levels that you'd see a good bottom in place, but we're getting there. Just seasonality starts to turn around. So it looks like we have a good shot at the strong seasonality heading into the last couple months of the year.
And Ed, you think about the relationship, again, I'm really stuck on it, between bonds and equities. Obviously, the Treasury market has done pretty lousy job of hedging the sell-off that we've seen in the U.S. stock market. What's the haven in this environment to your eyes?
Well, first of all, cash would be the place to look because of the inverted yield curve. But if you start looking at companies that can manage this interest rate environment, ironically, it tends to be some of those mega cap tech companies. People think of them as, quote, long duration assets, so rates go up so that they could underperform. But not all of them, but some of them have such strong cash hoards, they can actually manipulate the yield curve. They're making more money on the interest income from all their cash than they're actually paying out interest expense on their bonds. Whereas you compare that to small cap stocks, they don't have that kind of cash. They're having to go back to the capital markets on a regular basis. And so as they have to re-up when their bonds mature, they're paying higher and higher interest expense. So for the S&P 600 small cap index, their interest expense is actually at a record high, and it's been trending up for a little while now. So that's the challenge for these smaller companies or anybody who has to go back to the capital markets.
Yeah, that's a fascinating point on small caps when you think about some of the interest expenses that they're having to manage right now. But when you talk about some of those companies that are very cash rich and don't necessarily need to worry about some of that interest expenses, what kind of companies fit the bill here? Because my mind, for example, Ed, goes right to some of those mega cap tech names.
Well, those are the ones. We're not allowed to speak about individual companies, but I think with a little bit of work, our listeners can see who they are. But yeah, they're the ones that have been generating super high cash flow for years, have great margins, and built up these fortress balance sheets. They're the ones that can handle a higher rate environment probably better than most other companies.
All right, Ed, always great to talk to you. Ed Klissel there over at Ned Davis Research here. A look at, I guess, Katie Greifeld, at some of the market action and whether this is maybe just sort of a temporary seasonal blip. Maybe there's something more structural there. I don't know. I guess we're going to find out over the next few days and weeks.
The point on seasonality is pretty interesting, though, because I feel like I look at some of the seasonality functions on the terminal. I kind of ignore them, but we were warned September is ugly, and that's exactly what we're getting.
Yeah, I think everyone warned us on that. And like I said, as we were speaking with them, I was just going through those numbers here. Basically 4% down on the S&P, 5-6% on the NASDAQ right now, and even the Dow down 2%. We didn't even get to ask them about the Russell. That's down 6%.
I know. A really fascinating point, though, when you think about some of these smaller companies, maybe the maturity wall isn't as scary as maybe some had suggested. But for those smaller companies, interest expenses are real.
Yeah. The problem, though, is where else did you get a return this month, right? Because we talk about the downdraft that we saw in Treasuries on a price basis, and even some of the other areas aren't necessarily doing that well. We are moving closer to these closing bells here on this Monday afternoon. Our full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell. Here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms here on a soggy Monday afternoon in New York City. And a somewhat interesting market right now. Actually seeing a lot of price activity to the upside here, Carol, as we get closer to the bells.
Kind of interesting, right? Seeing some buying here into the close. Having said that, really one group that was a standout throughout the day was the energy group. Yes. Among the major industry groups in the S&P 500, top of the list, up about 1% overall. And what's interesting is, we're on track for a quarterly gain in the energy names, the biggest quarterly gain since March of 2022. We know the reason, right, in terms of supply curbs by Russia and Saudi Arabia. That's your big macro story, even though we cooled a little bit in oil today, but nonetheless, really a standout in today's trade.
Yeah, but kind of hard to find a standout today with, although we are seeing some buying into the close, still a really choppy session, Katie. And look, it's a holiday and volume's low.
Volume is low, about 10% lower if you look at the S&P 500's 20-day trading average. The point about energy, though, is interesting. The fact that you do see a little disconnect between what the equities are doing and what actual oil is doing, but energy just off to the races today.
Yeah, that's a really good point, right? We're back below $90 a barrel, but nonetheless, the trend has been for a stronger one. We're going to watch it, though, to see if somehow global economic demand is decreasing, and maybe that plays a little bit into it, maybe longer term.
All right, as we get the closing bells here in New York City, what had been a really mixed market here, from oscillations, from gains to losses, and now back again to gains. The Dow Jones Industrial Average higher by about 40 points, or 0.1%. The S&P 500 higher by about 18 points, or 0.4%. A similar move higher on a percentage basis for the NASDAQ Composite, and a similar move higher on a percentage basis for the Russell 2000, Carol.
Yeah, the Usher Index, though, on a tear. I saw what you guys did before.
Are we going to talk about Taylor Swift at any point? I know we have some stuff to get.
Later.
Okay,
All right, the S&P, let's do the divide. 300 names to the upside, 199 to the downside. Katie, for unchanged.
All right, I'll save the Taylor Swift comments. Let's take a look at some of these industry groups here. Like we were saying, energy, top of the pile. That's true on the industry group level as well, up 1.3%. You can see also chips getting some love. So too are some of the auto names. Actually more green than red. If you do look into the red, though, it's definitely some strong trends there. Household products, for example, off by about 0.5%. Food and beverage off by 0.7%. The staples today really taking a beating.
All right, so let's get to some of the individual gainers, if we may. And here's one. It's actually, I think, the number 2 gainer in the S&P 500, number 1 gainer in the NASDAQ 100. We're talking about GE Healthcare. I couldn't find any real catalyst. This company, though, on pace for its worst full quarter since being spun off from GE Electric last year. But this is after climbing about 41% in the first quarter, losing about 1% in the second quarter. quarter. It's down about 18% in the third quarter with less than 1 week to go. So this one, though, nonetheless, investors buying into it, up more than 3% in today's session. So talk about a wacky year for this one since being spun off. Amazon, you know the story. We've all been talking about it. It's big kind of AI play, if you will, spending as much as $4 billion on Anthropic. So it's been a crucial partner, and this is helping it move more aggressively into AI. There's a chip component to this. There's a cloud component to this. Read it. It's on the Bloomberg, but nonetheless, Amazon is standout, up 2% at its highs, up about 1.7% at its close today. And then CarMax, top in the S&P 500, heavier volume than usual. Keep in mind, they've got earnings on Thursday, so we'll be breaking down some numbers then. Wedbush upgrading the company to outperform from neutral amid improving market share performance. We'll find if that is truly the case on Thursday when they report. Also upping their price target to 90 from 85. Stock closing at 77 and change, just under 78, so some room to run there. It's up about 30% year to date. 12% of the float is shorted. It's still down 50% from its high back in November of 2021.
And I just want to add one to your list. Williams-Sonoma was on a tear today, up about 12% WSM ticker on the back of no real news.
It's that kind of a day, right? Like I can't tell you how many names I pulled up and there was nothing.
Yeah, it was. Same with decliners. It was actually tough to find stories behind some of these decliners, but I managed to find some. Let's start with HP
I think
Inc.
Romaine bought like a $12,000 couch and a $15,000 shelf.
Yeah, but you still have to wait 18 months to actually get it. HP falling 1.76% today. This after Berkshire Hathaway and Warren Buffett disclosed selling $125 million in shares. In its indirect sale, it took place in 3 transactions between the 20th and 22nd. That's according to a filing with the SEC. And I looked up a few minutes ago onto the screen what you guys were doing. I saw Joe Doe on the show talking about this story. Alcoa shares of the largest U.S. aluminum producer falling today to a 52-week low, down more than 6% on the day. This after the company abruptly named a new CEO. William F. Opplinger, who had been COO and before that CFO, will become the new CEO, replacing Roy C. Harvey.
Yeah, that was an interesting story because, usually, Tim, aren't there like succession plans? They kind of telegraph when it's.
This is the board met yesterday. The board met yesterday, put out a filing this morning, and said, hey, and perhaps that's why we're seeing shares down 6%. But this guy's been at the company for a long time, and he's worked in many different roles. So, yeah, we'll see what he ends up doing. Comes at a tough time for the industry, though. Yeah. Let's talk a little bit about Nike. This is actually, I think, among the most interesting stories in terms of stock-moving stories today. This is after Jefferies analysts downgraded the company along with Foot Locker and Urban Outfitters from buy to hold. The reason is because Jefferies did a survey and found that nearly 90% of respondents who they surveyed, about 600 of them, these are folks who have outstanding student loan debt. They were somewhat worried about being able to meet all of their monthly expenses. So Nike, they said, Jeffrey said, faces a risk from slower spending by those with outstanding student loan debt, as well as challenges from China. We're going to hear from Nike a little bit later in the week. The 28th is when that company is reporting earnings.
All right, let's take a look at what happened in the yield space, because that's where a lot of the action was. Another shift in the yield curve here, with a lot of the selling this time on the longer end of the curve. A 30-year yield up about 14 basis points here on the day. And we talk about this idea as to exactly what's being priced in. 466 right now on a 30-year yield, highest since 2011. A 10-year yield still camped out around its highest level since 2007. And a 2-year yield just a smidge below its highest levels since 06 here. So 5% on a 2-year yield, 4.5 on a 10, and 4.6 on a 30-year yield. The big question is, I guess, is what are people actually pricing in? Is it higher for longer rates? Is it economic conditions, or is it something else, Katie?
Is it more supply? Yeah. Is it the fact that maybe the U.S. economic growth outlook isn't so bad? Tim, what were you going to say?
I was going to say that I asked this exact same question to Ira Jersey a little earlier, and he said the market is now starting to price in a no landing scenario when just a few weeks ago we were pricing in a soft landing scenario.
I don't know. Did he define no landing?
Right?
It doesn't make any sense. Well, tell Ira it doesn't make any sense.
Did you?
You tell Ira.
No. I hope he's watching.
Katie Kaminsky was on with us from Alpha Simplex, and in mid-August, she kind of blew our minds when we said, well, how high could we go on the 10-year? And she said, maybe 6%. But what everybody talked about in this discussion we had today is that this inflation premium is continuing to be, people are trying to adjust for it. So
can we add a counterpoint to that? Because Katie and I interviewed a little earlier Gargi Chowdhury over at BlackRock, and the idea that she has in her latest fall outlook for the markets, she actually saw some buying opportunities, although she pointed out it's primarily in in the belly of the curve. So think like a 5-year yield instead of going out too long in duration. But the idea is there are some people looking at the level of yields and saying that there's still a yield story, but there's also a big price story in there as well.
Yeah, I mean, if you think about what usually the pitch for the belly of the curve is, it's that, okay, maybe the Fed isn't going to cut next year, but they're going to have to cut sometime in the next 5 years, maybe not because there's a downturn, but they want to get out of highly restrictive territory back somewhat to neutral, and that's where you get your rate cuts.
Yeah, but the big question is when does that happen? And there's so much, so much can happen between now and the next couple of years.
Does Carol Massar actually know who Usher is?
Definitely. She's
What
cool.
does that mean?
What were you guys doing? Why were we talking about Usher?
Interviewed
earlier?
Usher, Taylor Swift,
He's,
and Kim K.
he's headlining the Super Bowl.
Yeah.
Oh, I saw that. Yeah.
The Super Bowl halftime show.
That's pretty cool.
Tell me you're not a big football fan?
No, I am.
Okay. It's taken over the world. You don't have to be a football fan. Half the people just
I'd
watch
like
it
to
for
see
the...
Usher and Taylor Swift together.
Really? Interesting.
Well, okay.
Like dating?
Like,
because
yeah, what do you mean
that's where
together?
my mind is.
Yeah, because that's all Katie's been talking about is Taylor Swift showing up at some Chiefs game.
She sent me a message. Katie's very excited. She even sent me a message about
Katie,
it.
I will talk to anyone about
You
this.
need to calm down.
Are you more interested in the football side of this,
I know.
Katie? Because over the last couple of years, you have become more of a football fan.
I
Or is this more of a Taylor
I've been
Swift fan?
cosplaying as a football fan, so this is an exciting meeting of my worlds. I think I am a little bit into football, and I'm very into Taylor Swift. So this season just got a lot more exciting.
Has she ever performed at the Super Bowl?
I don't think so.
No, remember, it's a trick question. Remember they invited her a couple years ago, and then she had that dispute with, what was it, Scooter Braun, one of those producers where she couldn't perform half her music, so they were like, well.
We all know that when Romaine asks a question, he already knows the answer to it.
You're on to it.
Yeah.
After 2 years, you finally caught on.
I just can't wait till she works in all the football terminology into a song, right?
Oh my God!
You know there's going to be a breakup.
I'm so.
There's going to be a great song.
Carol.
Come on,
Carol.
come on. You know.
She was there with his mom. That's real.
Yeah.
You don't just hang out with somebody's mother.
I'm bullish. I think this is great. I'm excited to see how this turns out.
I got negative yields that I could sell you.
Okay.
Does that make sense? I don't know.
You know.
All right. We got to run. More Taylor Swift tomorrow because I feel like every day there's a story that has a Taylor Swift connection, whether it's about the economy. Yeah, fingers crossed, just for you, Katie. All right, thanks everybody.
See our planning meetings.
I can only imagine. We will catch you tomorrow across platform, radio, TV, YouTube, and of course Bloomberg Originals. Join us for Beyond the Bell and Countdown to the Close all tomorrow.
All right, always a fun conversation with our radio colleagues there, Carol Massar and Tim Stenovic. Stick around here. Romaine Bostick alongside Katie Greifeld. A focus coming up here on Amazon's big bet on AI. We're going to talk about the conversation that we had a little bit earlier with the CEO of the AWS unit, Adam Selipsky, about the company's $4 billion investment in the AI startup Anthropic. That conversation coming up next. This is Bloomberg. All right, it was an interesting day in the markets here on this Monday. Volume a little light because of the Yom Kippur holiday. Nevertheless, the price action really seemed to sense that actually the pathway for this market could potentially be down. Now, the S&P 500 did close higher on the day by about 0.4% here. But there's a battle going on right around that green line, the 100-day moving average here. And the bulls and bears are really fighting over what direction we go, whether this is the start of a fresh downtrend or whether that uptrend that we've been on for a good portion of the year continues. In order to see that continue, you're going to need some help from some of those big cap names. That includes the Teslas, Amazons of the world, Microsofts as well here. You got a little bit of help here on this day, but not nearly enough to really boost this market higher. Meanwhile, you had some of the smaller cap names try to reassert themselves. Nikola had a big run here on the day, up 12%. Williams-Sonoma also up about 12%, despite the fact there was no real news. Some interesting chatter here on consumer spending and whether it might actually hold up and whether names like Williams-Sonoma might benefit, but nothing really concrete to justify exactly why it rallied 12%. Meanwhile, Alcoa was down 6%, and there was a big reason why that was down, a big and abrupt change in its CEO leadership here without any real explanation as to why. That brings us back to the macro story, and that, of course, is what we're seeing in yields. The 30-year yield continues its march higher, now at the highest levels we've seen going back to 2011. But remember, once again, it's not the absolute level, it's the rate of change, and the rate of change today was big. At one point on the day, we were up more than 20 basis points, up about 14 basis points at the close here. And, of course, that's against the backdrop of what the Fed told us last week, and it's up against the backdrop of what could happen this weekend, and that is a government shutdown.
Well, before we get there, let's get to one of the big stories that happened on this Monday, and that is Amazon investing up to $4 billion in AI startup Anthropic in an effort, of course, to become a major player in generative artificial intelligence. Amazon Web Services CEO Adam Selipsky spoke to Caroline Hyde and Ed Ludlow from Bloomberg Technology earlier today.
We are fully urgent. We have a strategy that we really love. It is different than some other cloud provider strategies. It's true. We have a strategy of providing absolutely uncompromising security, which I don't think is true for all cloud providers. We have a strategy of providing customers the choices to use whatever's best for their job at hand. So Anthropic is going to be an amazing set of models for many, many use cases. And Amazon is fully invested in building its own Titan models, which I think will be really useful for other customers in other circumstances. And of course, our other model provider partners through Bedrock. So I really think it's an ill-founded premise that there's been some change in urgency. We're fully urgent here on generative AI for one reason and one reason alone. It's because our customers need us to have great generative AI capabilities. So many of them have their data platforms on AWS, and if you've got your data here, you really want to have your generative AI and all the powerful capabilities that you need from those capabilities in the same place. And so we have been, are, and will continue to be very motivated to deliver for customers.
Adam, what does this mean for the kind of ramp up or path forward for Trainium and Inferentia? You've put a lot of emphasis that Anthropic brings you a maker or creator of foundation models at scale. Will you now need to ramp up, I guess, your third-party manufacturing relationships to say, OK, let's get more Trainium, more Inferentia online to support the workloads?
Well, it's absolutely true that there is a huge demand for all of the different chips with which people do generative AI workloads. And so we absolutely have already been ramping up our training and Inferentia supply chain and ramping up the supply that we can create as quickly as possible. And yes, Anthropic will have access to very significant quantities of compute, which will have Trainium and Inferentia in them. So yes, that's one of many reasons why we continue to ramp up and to provide a very robust AWS-controlled supply chain for AI chips.
And is that where the revenue boost comes, Adam? Because we're looking at the share price reaction is higher on the day. When does this all start to really drive adoption, money, and the bottom line for Amazon?
Well, I think that AI in general, look, AWS has had machine learning services since at least 2017 when we released our SageMaker machine learning service, which has over 100,000 AWS customers on it. So we've been doing machine learning for a long time inside of AWS. And obviously, more recently, I've had a significant number of generative AI customers. And we will certainly continue to ramp up. I anticipate, quite steeply. We have many sources of growth inside of AWS. We're a scaled and relatively sizable business at this point. And customers are running their data platforms on AWS. They are building out more and more applications for things like supply chain and contact center management on AWS. There's still a whole lot of storage and compute and database workloads ramping in on AWS. So we have many sources of growth, I anticipate. But there's absolutely no doubt that generative AI looks like it's going to be an explosive additional source of growth in the years ahead.
That was AWS CEO Adam Selipsky speaking on Bloomberg Technology earlier. And for more, we're joined by the co-host of Bloomberg Technology, Ed Ludlow. And Ed, I'm going to start with something I emailed you about earlier today. When we say that Anthropic is using AWS's chips, what do we actually mean by that?
Yeah, it's the same misconception that when we're talking about NVIDIA and the H100, right? If you're an AI startup that's building a foundation model or a large language model and you say, I have a cluster of this many chips, you're not sort of talking about a straw bag with all of your semiconductors inside it. The reality is that all of the compute workloads to train foundation models are done through data centers, right? And those individual chips go into servers, the servers go into banks that build up the data centers. AWS is the leading cloud provider, and all they're saying is that in some of their data centers around the world, they've introduced their own chips, proprietary silicon they've designed themselves, specifically Trainium and Inferentia. And they have multiple offerings. They have sort of lower spec, lower compute data centers. Then they have the highest spec built on their proprietary silicon. And part of this deal, and probably the most important part, is them saying, look, we have a leader in the field of AI choosing to work with us and use our semiconductors powering our data centers for the next generation of AI.
Give us a sense here, though. We talk about the investment that they made here, and obviously they use the word partnership here. But
Yes.
what are we talking about? I mean, what is sort of the ultimate ambition?
Well, one way of looking at it is reverse revenue, right? They're making up to $4 billion in equity investment, but you could say, are you guys just spending $4 billion to convince an AI startup to use your chips? That's kind of the cynic's view. Adam explained their business model, right? OpenAI is a maker of large language models. Microsoft invested in OpenAI to give its cloud clients access to those large language models and give a value add to cloud computing. AWS is doing essentially the same thing. They're saying we recognize that Anthropic is a leader in generative AI tools. If you are an AWS customer, you get first dibs on their next generation of AI when it comes out. And we're supporting the compute, so we're closely aligned to it. You know, the strategy, Romaine, from Amazon has basically been to say, we're not going to narrowly focus on our own chatbot. What we're going to do is be a place where you can either build your own large language model, take advantage of an existing large language model, and because your data is already housed in our cloud computing, there's an easy crossover here. If you're an enterprise company or a SaaS company, it's easy for you to work within our mainframe.
Yeah, while we're speaking here, Ed, I'm meaning to put you on the spot. We're getting some headlines. This involving another Jeff Bezos property, Blue Origin. We're learning now that the CEO there, Bob Smith, is stepping down. Of course, Bob has been helming this space tourism company, if you want it, for lack of a better word, since late 2017 here. We don't have any real details right now, other than an internal email that Bloomberg reporters have obtained suggests that Bob Smith is stepping down. Ed, I know we haven't spoken a whole lot lately about what's been going on with Blue Origin, but I know you've covered this sector, this sort of space race, if you will, very closely here. Where does Blue Origin stand in that space race right now?
Yeah, so on Bob Smith, he has been at Blue Origin for around 6 years. In the time that he's been there, he's kind of operationalized what was a plucky startup. He's grown their facilities and operations team. My understanding, and I was kind of aware that this was coming, is that he will be in place until the new year, at which point they'll find a new CEO in transition. But Blue Origin's kind of fallen behind. It has two parts to its business. It wants to be a tourist operator. You know, we've covered the launches, Romaine, you and I, of the celebrities going just above the Kármán line. And I love them too. But its other business is to build rocket engines for other rocket operators. And that's where it's fallen behind. And the Ukraine war was really interesting because they framed the Ukraine war as an opportunity to displace the Russian-built engines. It's just that they've never really cracked the technology or the production of them.
All right, I'm going to have to leave it there. Ed Ludlow, of course, the co-host of Bloomberg Technology. We brought him on, of course, to talk about AWS and its new ambitions with Anthropic, ending, of course, on Jeff Bezos' other property, Blue Origin, and the CEO, Bob Smith, there, stepping down. A lot more coverage coming up, including Moody's issuing a warning about a potential U.S. government shutdown. Yes, another potential downgrade because of the dysfunction in Washington. That conversation after the break. This is Bloomberg. All right, let's turn back to politics right now. The U.S. government in danger right now of shutting down again. An impasse amongst the Republican Party that controls the House of Representatives means that the deadline this weekend, September 30th, to pass a new budget, right now looks in doubt. Kayleigh Lyons joining us right now, the co-host of Bloomberg's Balance of Power. And Kayleigh, let's start off here with the big news to start the day, and that was Moody's Investor Service, the only remaining major credit rating agency to assign the U.S. a top rating, says that top rating now in jeopardy because of the dysfunction in Washington that you know so well.
Yeah, Romaine, this all feels very familiar. Moody's not downgrading the U.S. yet, but essentially sending a warning shot across the bow about political dysfunction. To quote exactly from the statement, they say that a shutdown would underscore the weakness of U.S. institutional governance and strength. The statement goes on to say it would demonstrate the significant constraint that intensifying political polarization continues to put on U.S. fiscal policymaking. And the reason this might sound so familiar is it was just back in August when Fitch downgraded the U.S. credit rating because because of governance issues and political dysfunction. It is about the discord we see in trying to get spending policy or debt limit policy, as the case has been in the past, done here in Washington, and essentially another ratings agency saying that that could affect the credit worthiness of the United States, keeping in mind as well that a lot of this is about the longer-term trajectory of the U.S. debt, which just continues to build.
Yeah, and we'll have to see if Moody's follows its peers if we actually do see the government shut down. And to that point, the deadline quickly approaching. What do the efforts look like to avert that shutdown, if any?
Well, they're definitely trying, Katie. Granted, they're not trying from here in Washington. The members aren't actually here, given the Yom Kippur holiday. They will return tomorrow, at which time they're only going to have a few days to try to avert a shutdown by that September 30th deadline. The mechanism of doing so is going to have to be a continuing resolution. They simply don't have time to pass all 12 appropriation bills they would need to. How long that continuing resolution is, though, in the House, and whether it can get adequate support in the Republican Party, considering Speaker McCarthy can only afford to lose 4 votes, is an open question. Granted, the Senate also is working on its own CR through the mechanism of the FAA reauthorization bill. That is something Majority Leader Chuck Schumer is going to try to be working on this week. Either way, though, you're going to need to find some bipartisanship somewhere, and that's a little bit hard to find, at least in the House of Representatives at this time.
And just real quickly, Kayleigh, when we talk about the folks who are maybe holding this up, the idea that there's a certain faction of the Republican Party that doesn't want to see these CRs, is there anything on the table that I guess could potentially lead to compromise? Anything that McCarthy can offer those folks?
Well, he's tried to offer things like tying up border measures with appropriations bills and massive spending cuts. What's on the table now is a cut temporarily of 27% to domestic programs in return for extending the funding of the government anywhere between 14 and 60 days. We don't know that some of these individual members, though, like Matt Gaetz, the Republican congressman from Florida, though, will go for it. The issue is it is a bunch of individuals who all have different priorities, different things that they want, some of which are in conflict with each other. And that makes Speaker McCarthy's job very hard here.
Yeah, well said, Kayleigh Lyons. You can catch her on Balance of Power, which comes on after this program. And I'm told Balance of Power will still continue, even if the government shuts down. Coming up here on The Close, we're going to talk about the latest trends in private equity. William Barrett, managing partner over at Reach Capital, he's going to be joining us after the break. This is Bloomberg. The market's on this Monday trying to claw back some of the losses that we saw from last week, a week where we saw the S&P have its worst week going back to March. The gains today were fractional, to be sure. Some help from the Magnificent Seven, but not a whole lot of help from anything else. The outperformer on the day, at least on a sector basis, was the energy sector, with most of the names in that index managing to post gains. Nevertheless, the story still remains the Treasury market, which saw its sell-off now enter into what is going to be potentially a 5th straight week of declines on a price basis. That means yields higher as we go forward as well. The activity on the longer end of the curve causing a lot of head scratching here about what exactly is being priced into this Treasury market, whether it's concerns about the Fed, the pace of rate hikes, or whether it's something more akin to what the economic conditions will look like heading into 2024. The VIX elevation here on this day was maybe balanced out just a little bit by a downdraft that we saw in the commodities space here. You put it all together, and with volume a little bit light, don't read too much into the price action, but if this continues over into Tuesday and beyond, I think you can put together a narrative about where we might go next.
Well, Romaine, switching gears, the International Private Equity Market Conference wrapped up in Paris last week. And of course, one of the big questions was whether private markets can truly outperform other asset classes. William Barrett, he is managing partner over at Reach Capital. He spoke at the conference and he joins us now from Paris. William, it's great to have you with us. And all year we've been talking about private credit and the growth that we're seeing, particularly in that market. But talk to us about private equity and the state of fundraising there.
Yeah, thanks for having me, Katie. The state of fundraising, it's definitely helping fundraising for the large cap players. That what we see is kind of a flight to quality there. So a number of LPs are kind of going back to the big brands that they know in private equity and investing with them. So it is definitely challenging for small to mid-cap players. They, even though, as you were saying, they tend to overperform, there's data showing that funds below $1 billion are overperforming most of the other players, over the last 20 years. But still, they feel they're facing a number of challenges. Usually they have a concentrated investor base, and they haven't built that of a diversified investor base, and they don't have the resources to do that. So they don't have that many investor relations, or they don't have the right advisors. So that's challenges that they're facing.
And William, to what degree are some of these PE players competing with private credit? Romaine and I had a really interesting conversation a few weeks ago with Armen Panosian. He is the incoming co-CEO over at Oaktree, and he made the point that you're seeing private credit really lure cash away from the private equity world. Are you seeing that as well?
Yeah, 100%. So it feels like, you used to compete with other buyout houses. KKR was competing with Carlyle, was competing with Blackstone on the buyout segment. But now it feels like you're competing also against credit on one side, also against private equity secondaries, and they're all aiming at pretty much the same returns. So, most investors today are expecting 8 to 14% net return from private equity. And guess what? Other asset classes are also aiming at this type of returns. So therefore, you're competing against them also.
I am curious, about when we talk about all the proverbial cash on the sideline that some of these funds have, and the story, at least based on the Bloomberg reporting, something like you have private equity funds that launched before 2010 still are sitting on $80 billion. And I'm curious if you get to a stage here where when you have that much money that has been dormant for so long, it ends up making investments that, quite frankly, just aren't prudent.
Yeah, so I think that's a risk, and especially again for large cap players, because if you look at M&A, volume, as you were saying, Romaine, these volumes on a global level are down 44% year to date. Now, when you look at the number of deals, and if you look especially at deals below $1 billion in value, these volumes are pretty much the same in H1 23 than in H1 2019. So what you're describing, I think, is driven by a lot of money that was raised on the large cap side.
Yeah.
At Reach Capital, we don't see that much of a slowdown on the small to mid cap segment. It feels like these guys are keep deploying and keep exiting these deals.
Well, I am curious, too, about what the investors and the limited partners are asking for here, because if you go back, I don't know, a year and a half ago, before the Fed really started to increase rates here, you had a baseline Fed funds rate that effectively set the baseline for what types of returns folks expected in the markets. But now, of course, with the Fed funds rate above 5 and several key measures in the Treasury space above 6 here, it gets to the stage as to what return can they reasonably offer that's going to be competitive with what you can get potentially for something with less risk and no lockup.
Totally. That's the $1 million question, right? It's the key element of how competitive private equity can be, knowing that, as you were mentioning, private equity is now paying for leverage, right, and a pretty high price. So I think what you're describing here is one of the reasons why we see a number of investors that are questioning the private equity model and kind of going back to the fundamentals being EBITDA growth and being, build-ups and growing the company itself and not that much relying on leverage. And guess who has done that in the past? Small to mid-cap players, sector specialists. So we see more appetite in private equity going towards these type of managers to, kind of counter your point.
And William, let's go back to private credit and the question posed at the start, which is whether private markets can and are truly outperforming, because you think about this higher interest rate environment, and it's really caused a lot of tumult when it comes to public markets, both on the equity and fixed income side. When it comes to private credit, it's obviously attracting a lot of eyeballs because it is so big, and we don't have a real sense of what's going on there. When you take a look under the hood, do you have a sense of what the fundamentals look like there, what the default rates actually look like?
So, from the discussion we're having here, with a number of managers, we have a number of clients that are in the private credit space, either on the corporate side, but also on the infrastructure side, or on asset-based, also credit. it feels like they're not that worried on the situation, and it feels like the companies are performing quite well. And they're maintaining their margin, or if not increasing their margin. So, again, it feels like credit is more competing now with returns of private equity. I think here we're a bit more concerned about how down the level of private return is going to be, rather than the credit side. It feels like the credit side is pretty much maintaining their margin, if not increasing it again.
All right, William, great stuff. Great to catch up with you. William Barrett there. He's managing partner over at Reach Capital here. A discussion about what's going on in the private equity space and the big take on the Bloomberg terminal today about the wave of zombie companies rising from the private equity slow carnage. A great read here on the terminal. Coming up, we're going to check in with some of the labor strikes that, of course, taken everyone's attention. A tentative deal with the Hollywood studios and the writers. Actors still walking the picket line. We're going to talk about what it means for the state of Hollywood after the break. This is Bloomberg. After almost 5 months, Hollywood writers and studios have reached a tentative deal over the weekend to end the strike. The agreement settles one of 2 walkouts that have effectively shut down most of film and TV production here in the U.S. For more, let's bring in Chris Palmieri out in our Los Angeles bureau, who's been covering this story for us. And let's start off with the writers here, Chris. This was 5 months in the making here. General outlines of the deal. What do we know?
We know that they got paid more. They were looking for a salary increase around 5% over the 3-year contract. They were looking for assurances that they were getting paid some additional residual payments from the success of their shows on streaming services. This has been a big change, from traditional TV viewing to streaming, and they felt like the terms of their contract hadn't kept pace. Another big issue was artificial intelligence, whether they were going to get replaced by robots who wrote screenplays. And we understand there was some concessions there, the studios guaranteeing that there would be humans involved.
Based on what we know about this deal, and based on what we know that the actors union, SAG-AFTRA, has been asking for, and of course that strike now past the 2-month mark here, is there enough overlap between what these 2 unions were asking for where maybe we could see an agreement with the actors soon?
Everyone expects that to be the case. There were a lot of the same issues. The writers had some specific things, such as minimum staffing level on TV shows. They made gains there as well. Actors have their own individual issues, whether they get paid for doing auditions and that. But the thrust of it is there's this huge technological shift, both with streaming and with artificial intelligence. And everybody in creative industries is worried about how they're going to be compensated in the future.
Well, Chris, when it comes to the writers and the studios, so this is a provisional 3-year deal. How confident are we that we won't just be here again in 3 years?
Well, they made gains. I mean, the writers have likened this to negotiations they did years ago, for example, when cable TV emerged, or even just to gain, decades ago, to gain payments for reruns and that. So this was positioned as sort of a historical moment on streaming in particular. And while certainly a new contract 3 years from now will bring some new issues, it's unlikely to be a total rewrite of this.
And of course, we're still waiting on the actors to maybe make a deal with the studios. But what do we have to look forward to? When we look at the TV schedule, I see that Dancing with the Stars, for example, is coming back tomorrow.
Ooh.
Drew Barrymore, we're told, is coming back. Saturday Night Live is coming back. All of these shows that were really quick to cancel, are coming back to talk shows, and that we expect to soon see some news from the late night talk shows. The things that will be harder to come back, but inevitably will be the scripted comedies and dramas that you need both writers and actors for.
All right, Chris, I'm going to look forward to, I guess, to some of those shows. Not necessarily, I've never seen the Drew Barrymore show. I don't know if it's good or not. Anyway, we're going to find out soon. Chris Palmieri there out in Los Angeles, keeping an eye on 2 of the strikes going on out there. One of them appears to be resolved. Of course, the big elephant in the room is what's going on with the auto workers. We want to talk a little bit more about the economic impacts of these strikes and bring in Patrick Anderson, Anderson Economic Group Principal and CEO. And Patrick, let's start off here with kind of the so-called cascading effects we get from these strikes. I remember when the writers went on strike, there was all this talk, not just about the 10,000 or so writers that were walking off the job, but that entire ecosystem that is built around a Hollywood film production. That means that if you're a caterer, you got nothing to do. If you were, I don't know, a technician of some kind, you had nothing to do. How does that sort of affect itself? How do you sort of equate what the real economic damage is?
The auto industry is one of the highest value-added industries that anybody has anywhere in the world, and we're fortunate to have such a great auto industry here in the United States. What that means, though, is when you shut down parts of it, production plants, assembly plants, you end up shutting down a whole chain of suppliers leading up to it, plus distribution, parts, even making it difficult for dealers to get parts for vehicles to fix. So it's an extremely high multiplier effect, so to speak, in terms of the number of jobs that are affected by a strike.
And we've already gotten some evidence with some of the automakers laying off non-union workers, basically saying that if the union workers aren't there, you can't run the plant. We've heard from some of the parts suppliers saying that they have no reason to continue production right now. And then, of course, even the dealers have complained because they've said, well, at some point, we're going to run out of inventory and we need to sell cars.
That's right. And our estimate ahead of time was that this would be $1 billion, multi-billion-dollar cost to the economy, most of which would be borne by people who did not go on strike, people at dealers, people at suppliers, people working elsewhere in GM, Ford, and Chrysler. And that's definitely working out to the case. And in fact, the UAW's strategy here is actually to limit the number of their own workers that are going on strike and increase the pressure on other companies, notably suppliers and dealers.
And talk to us a little bit about how pain multiplies the longer this strike drags on. Currently, we're about a week or 2 in. If that becomes a month, potentially, or longer, what potentially could that mean?
We estimated that there would be a $5 billion impact of a 10-day strike against all 3 automakers. That's a lot. That would be really more than any strike we've had in the United States in recent history. 1 week in, it's already $1.6 billion, and we're a week and a half in. So it's going to be hard to shut this down with even 2 weeks, even if we got settlements in the next 48 hours, which I'm not projecting, particularly since we have both a current and former president coming in over the next 48 hours to rile things up even further. So the amount will grow. So the $1.6 billion first week cost is going to be less than the second week cost.
And Patrick, we touched a little bit on inventories, for example, and looking through your notes, the point is made that automakers, they only have about 1/5 of the inventory that they had in 2019. What could that potentially mean for consumers, for example?
You're right. Our analysis of the strike this time around shows that dealers have a much smaller inventory, which means within days of a strike, you're going to start to see an inability to get the cars to market, and consumers thinking they may not be able to order a car from GM, Ford, or Stellantis. Now, we've had this stand-up strike. All production facilities aren't shut down, but every day we get more production facilities and more parts, and the UAW's decision to strike parts centers means that people have trouble getting their cars repaired. And this is, it's an escalation in terms of the impact. It also risks affecting a lot of people that, they're not UAW members. They didn't go on strike. They may be in sympathy with union workers' demands for higher wages, but they're wondering why that means they can't get their truck fixed. So it is definitely something that is a two-edged sword.
Yeah, certainly. I mean, just going through your data and you look at the direct losses and then, of course, you look at the more industry-wide indirect losses here, Patrick. Is there any sense here that some of that money, some of those losses gets recouped, or is that money, that potential money that would have been portioned out, that's just gone?
Unfortunately, strikes are very expensive things to do. And on this, I think anybody who's serious about it knows when you strike, you don't get any wages. And those families out there on the picket line, they may get a little bit of strike pay, but they're not getting their wages. They're out there marching up and down. Meanwhile, the people working elsewhere in the industry don't have product to sell. And a lot of it's the people that I really feel bad for are the suppliers. Often these are family-owned businesses, smaller and medium-sized businesses. They don't have a vote in this. And right now they don't know whether their product is going to be demanded and sold next week, or they're going to have to sit there with it until the plants reopen. So this is spreading out. The cost is significant. And if it continues, you're going to see states like Michigan and Ohio that have a lot of auto facilities from GM, Ford, and Chrysler, potentially go into a one-state recession, which is what happened in 2019.
Well, Patrick, the point about the suppliers, I find that really interesting, the point that they don't have a vote here. And when you think about that $1.6 billion lost just in the first week of the strike, how much of that is actually being borne by these suppliers?
A substantial portion is borne by the suppliers. In fact, a larger part is borne by them than would have happened had there been a traditional take one company and strike all plants approach, because these suppliers, sometimes they have maybe 2 or 3 contracts and they're dependent on production at this plant and that plant. So the smaller ones in particular are in a situation where they literally don't know what they're going to be selling even a few days from now. The UAW action on Friday, they made the announcement at 10:30 in the morning, and you actually had picket signs out at noon the same day. So it's something that if you're wanting to have maximum leverage, which the UAW wants in a strike, they're clearly exerting that leverage. But if you're a supplier, you're feeling the pain. If you're a dealer, you're starting to worry about this. And of course, if you're the manufacturer, you're already losing money, but you're part of it. So you at least have a vote in that.
Absolutely. Great stuff, Patrick. Great research, too. Patrick Anderson over at the Anderson Economic Group, taking a look at the financial fallout here from the UAW strike, now in its second week, of course, on the heels of what appears to be a resolution of another strike with regards to the writers in Hollywood. A lot coming up here on the week that is just starting here. We're going to set you up for what to watch on Tuesday. This is Bloomberg. Let's push ahead to what markets will have their eye on Tuesday. And we start here in the U.S. with some economic data, including U.S. home sales. U.S. home sales, we're going to get consumer confidence as well. It's going to be interesting to see that and see the interplay between home sales and consumer confidence, because it feels like no one in the housing market is happy right now. Yeah, absolutely. Unless you're a new home builder, you're doing pretty well.
True,
so
that's true.
We'll see. We're also going to see whether anyone's going to be happy about what's going to transpire over the next couple days in Detroit. The president, Joe Biden, scheduled to be on the picket line with the UAW tomorrow. This is a political issue and then some. It's going to be really interesting to see the images out of that and also the messaging as well from the Biden administration. Absolutely. And we should point out that this visit coming about 24 hours before what is presumed to be his main challenger in the presidential election, a former president, Donald Trump, is scheduled to be there on Wednesday. Meanwhile, back on Tuesday, speaking of politics, Lina Khan of the FTC, a fireside chat with her tomorrow. And the FTC under Lina Khan has been very aggressive, has been handed some losses. Going to be interesting to hear if she backs off that strategy at all. Yeah, she had a couple of big court losses. It'll be interesting to see whether she still stands by that. I mean, I think she's kind of said that it doesn't matter, but I don't know. I think for other people around her, maybe it does. And we get earnings, Katie Greifeld. Earnings season never ends. Never ends. Yeah. Costco. We talk all the time about this trade down. Going to see if that's happening at Costco's business as well. All right, that does it for Katie and I here on The Close. Balance of Power is coming up next, but don't worry, Katie and I will be back tomorrow, hopefully. This is Bloomberg.